Good morning. I'm gonna keep on saying good morning until somebody replies back. Thank you. Alive we are. So good morning, ladies and gentlemen, distinguished speakers, all protocols observed. And a very warm welcome to the capacity building workshop to build the capital market ecosystem here in Ethiopia. Before I introduce our guest of honor to deliver her opening remarks, a few housekeepings as always needed. As always, I would really ask for you to take your phones out and put them on silent. Okay. I see people are doing that. Okay. So when you came in, to your left, you might have seen the washrooms. So in case of anything you need, the team would also be on standby to assist with anything that you might have. So with that, and without taking much time, I would like to ask you all one big favor, which I always do. Whenever a guest or a speaker is coming, with our lovely tradition as Ethiopians, you would be giving them a warm hand and they would be opening up their heart fully. So don't forget to clap, huh? So with that, please help me in welcoming Her Excellency Ms. Meklit Sahalu, Deputy CEO of Ethiopian Investment Holdings. We should have put the stairs here, but we learn from mistakes.
Good morning, everyone. Excellencies, invited guests, ladies and gentlemen, good morning and welcome. I would like to begin by saying a special thank you to the UNECA, Bill and Melinda Gates Foundation, and FSD Africa for the special support provided in organizing this capacity building workshop. This illustrates the strong backing towards establishing capital markets from our development partners as we work hard towards the launch of the Ethiopian Securities Market. As you know, Ethiopian Investment Holding is established as a holding company to manage and improve the performance of state-owned enterprise, as well as attract strategic investment into the country. EIH has made achievements since 2021 in attracting investment and in managing and improving the performance of state-owned enterprise. We are proud of the accomplishment in the past 1 year, but we are even more excited about the future. The establishment of the ESX is part of the strategic investment objective of EIH given to it by its board of directors. The launch of the capital market is one of the government Ethiopia's key economic reform element in the homegrown economic reform agenda. Since June last year, we have set up and dedicated a project office that has taken the responsibility of establishing ESX. To date, we have taken a significant step towards the establishment of the capital market, including the development of business plan, governance, technology need assessment, and various other activities. Ladies and gentlemen, the capital markets provide a critical avenue to address development goals by helping fulfill the capital needs of development of the country. The presence of the capital market significantly promotes and provides new options and instruments for investments, as well as improving access to finance. The government of Ethiopia's commitment to privatize certain public assets for public ownership through the EIH will play a key role in supporting the development of the capital market by listing this asset on the ESX. This will not only support the exchange in developing its initial pipeline of portfolio companies, but also democratize the public ownership of public assets. In conclusion, I would like to reiterate that as the leading promoter of the exchange, EIH is fully committed to supporting the launch of ESX. The ESX team will work closely with relevant intermediaries to prepare them for the launch of the market through a series of tailored training, a public consultation, such as this technical workshop you are part of today. I sincerely express and hope that this will be a fruitful and successful event. Thank you very much.
Thank you very much, Her Excellency Ms. Meklit Sahalu, for that reaffirming the commitment that EIH has in establishing and supporting the capital markets, and also, but thereafter, the Ethiopian Securities Exchange. With that, you have also mentioned Bill and Melinda Gates Foundation, who are the ones who are supporting in this workshop. So it's only right, just after you, that we call upon Mr. Peter Hurst, who's online, the Senior Program Officer for Bill and Melinda Gates Foundation, to give us a few remarks on the same. Peter, can you hear us?
Yes, I can. Can you hear me?
Loud and clear.
Fantastic. I'm very pleased to be with you here today, dialing in from a very early morning London to introduce today's session. I'm sorry I can't be there in person. So my name is Peter Hurst. I'm a Senior Program Officer at the Bill and Melinda Gates Foundation, where I support countries to mobilize finance for development, and specifically lead my team's work in Ethiopia. So the Gates Foundation finalized our first partnership with UNECA at the height of the pandemic in 2021, with the aim of supporting Africa's development finance. So at that time, we were worried that the continent would be increasingly financially squeezed, given the pandemic and inflationary pressures. Sadly, this prediction has materialized, with more shocks than initially anticipated, such as the war in Ukraine and climate shocks that have impacted agricultural production. So the Ethiopian economy has certainly experienced some of these shocks, both global and domestic, that have dampened growth and left the government facing a very tight financing situation. A significant part of our partnership with UNECA is focused on the international agenda. As you might be aware, Prime Minister Abiy Ahmed was in Paris just a few weeks ago for an international summit on global financing, which really emphasized the importance of innovation and global solidarity. But the large part of development finance needs to be funded domestically, and there's an absolute need to bolster and modernize domestic finance channels as much as we ask for global efforts. So economic reform, and in particular the liberalization of Ethiopia's financial sector, is going to be so important in attracting investment to bring in more foreign capital, grow the domestic market, and ultimately address the macroeconomic imbalances that have built up over many years. I was in fact in Addis just a few weeks ago and was very excited to hear the depth of reform that the government has planned through their homegrown economic reform agenda. So an Ethiopian Securities Exchange is going to be a key part of those economic reforms, as it will help build up that broader ecosystem of institutions and markets that will make up a functioning capital market system, which will help drive growth in one of the largest economies in Africa. So I hope that you have a good day of discussions today. I've looked over the agenda and I'm very sad that I can't be with you to hear the presentations and engage in discussions. I'm sure that you'll have a productive engagement and genuinely learn among participants. So have a fantastic workshop, and I look forward to hearing about it soon.
Thank you very much, Peter. I don't think you have missed anything. Virtually, we seem to be in the same room. So, and I think it's quite early, so we can let you go to have some break or coffee back. But thank you for giving us that opening remarks, Peter. Thank you very much. You should see the clap in the room for you. Okay, thank you very much. So in the spirit of maintaining the momentum we have, I think we would just straightly jump to the presentation session. And here with us, we have Mr. Solomon Bekele, Senior Legal Advisor for the Ethiopian Capital Markets Authority. Okay, I was searching for him with my eyes to share with us an overview of the Public Offering Directive and the regulatory and institutional environment. So thank you very much.
Thank you. Good morning, everybody. My name is Solomon Bekele. I'm a Senior Legal Advisor at the Ethiopian Capital Market Authority. As mentioned before, my presentation will be on the regulation of public offer. So my presentation, hello? Okay. So my presentation will touch upon some kind of introduction to capital market. Then I will touch upon registration and prospectus, advertisement, ongoing disclosure, and lastly, the IPO process and its significance. So what's public offer? Public offer is the process by which companies raise capital through sale of securities. So the proclamation defines the capital market proclamation defines public offer as the act of offering securities to the general public in order to raise capital by the promoters prior to the incorporation of the company or by the issuing company prior to the issuance of said securities. Basically, this means this envisages two kinds of companies. The first one is companies that are under formation, and the second one is companies that are already in existence and needs to raise capital. So in this second one, companies that are already in existence, we can divide them into two ones. The first one would be companies which has never before offered securities to the public. The second one is companies that has already offered securities and they are in the public realm. So, for example, the banks, the insurance companies, and other entities who are in the public domain who has already offered securities, and if they want to raise additional capital through other round of public offering, then that's also considered as public offer. So the other thing that I would like to mention here is, though we're familiar with the offering of shares, securities include not only shares, but also bonds and other products. So, we're familiar with share offerings that has already occurred in this country, but bond issuance is not, other than the government, we do not have any experience regarding issuance of bond by companies. So the regulation of the capital market, the public offer, will include this kind of offerings too. Then there is also the thing that we call IPO, initial public offering, and follow-on offerings. So initial public offering is when a company which has never issued securities before issues securities to the public, then we call that initial public offering or IPO. And there is also follow-on offering. This refers to offering by companies which have already offered shares and sold shares to the public previously if they decide to raise additional capitals in the future and go ahead with that kind of offering, then we call that a follow-on offering. So the regulation or the proclamation as well as the directive that will come out based on the capital market proclamation regarding public offering will include all these kind of offerings and will govern all these kind of offerings. So the main thing about the drafting of this kind of legislation is it's a balancing act. Balancing, there we have, as an authority, we have 4 mandates. The first one is investor protection. The second one is avoidance of systemic risk. The third one is having fair and orderly market. And the last one is market development. So we balance, when we draft the directives, we balance these 4 competing mandates that we have. So on the one hand, we would like to facilitate capital raise. On the other hand, we would like to protect the investor. So the mechanism that we implement to protect the investing public is disclosure. What do we mean by disclosure? If I can give you a simple day-to-day life experience, if somebody wants to buy a pant from a clothing store, when I say pant, growing up here, what we refer pant, when I say pant, I'm referring to this. So growing up here in Ethiopia, we used to call this trouser. Then we went to the US and this became a pant, and the pant that we know here became underwear. So I would like to disclose this so that your creative mind will not be traveling farther away. So this is what I'm referring to. So if we go and we go to a store to purchase a pant, the first thing that we do is what? We inspect the pant so that to make sure that this is the quality that we want. And the second thing that we do is go into a fitting room and try it out. So what we're doing is, the first inspection is making sure the thing that we're buying is the quality that we want. And the fitting process is making sure this fits the purpose. It fits me so that I can wear it. That's the purpose that I'm buying this trouser for. So similar logic, disclosure, make sure that the buying or the investing public has all the information that they need to make the investment decision. So how do we do that? How do we enforce this kind of disclosure? There are 2 stages that we do this. The first one is during the offer process. The second one is on the ongoing basis. So this is the summary of the public offer law. So the first one is the first one that you see on the left side. It refers to the offering process. The one on your right side, the ongoing disclosure, is something that happens after the closing of the offering process. So during the offering process, the disclosure that we require registration. We implement the disclosure process through the registration and preparation of prospectus. Then within that, we see the content of the registration statement, content of the prospectus, and we'll also see a little bit about advertisement. And there are also exemptions from the registration and preparation of prospectus, and we'll look at that. And the other thing that we're going to see is once the offer is closed, and during the existence of the company in the public market, in the public sphere, then we see what kind of ongoing disclosure that's required of those kind of companies. So registration of securities. The proclamation states that a publicly traded security is required to be registered prior to the offer or placement, and the registration is done before the authority. So that's what is, and the reason or the objective of this registration is to make sure that adequate information is provided to the public by the issuing company, so that the investing public will know the risk that they're getting into, or the gain that they will be with the gain that might be available to them. So during this process, even if we require a registration process and we require the companies to register with us, our place is not to determine the feasibility of the business study. Our place is to make sure that adequate information is provided to the investing public. So regarding the content of registration statement, it will have these contents: issuer's information about the security, issuer's qualification, and the major one will be the prospectus. So what do we mean by the issuer's information? So we'll see who is the issuer, what's its legal status, when was it established, all those kind of information of the business place, and all those information about the leadership, all those information about the issuer. Then information about the security. In that, we'll see whether it's going to be a share or a bond. If it's a share, what kind of rights attached to that to that share? If it is a bond, then what kind of the term, the interest rate, the periodic payment, all those information will be included in this part. Then the last one, issuer's qualification. If there is any qualification that's required of that offer, then that will be there. Prospectus is the major information where the meat of the disclosure happens. In that, we'll see all the information about the issuer, the financial information, the management, the risk, the management discussion, historic financial information, all those kind of things will be in this prospectus, so that this is the main part of disclosure. So what's a prospectus? A prospectus is defined in the proclamation as a document or a publication by or on behalf of a share company containing information on the character, nature, purpose of the issue of shares, debentures, or other corporate securities. Basically, this is where you get, as I just said, this is where you get all the information about the issuer, its business, its financials, and everything, its leadership and everything. And also what it does is it extends invitation to the public to purchase the securities. And the other main thing here is, the prospectus, as I said, should be filed with the authority and get approved before the issuer can either offer or even advertise. So regulation of advertisement is going to be a big part of the law. And we have seen, especially recently, we have seen a lot of advertisement regarding issuance or offering of securities, which are, to say the list, which are very dubious. So we will be regulating advertisement. The authority will be regulating advertisement. And some of the things that we will be seeing on the regulation of advertisement. Of course, there is a law. There is one proclamation that deals with advertisement, which is mainly administered by the Ministry of Trade and Regional Integration. But the funny thing about that proclamation, if there is misinformation or any mischaracterization of information on the advertisement, the recourse that the government has at this time under that proclamation is to order the advertiser to remove the advertisement and correct any kind of misinformation that's being provided. But our proclamation and our regulation or our directive on this regard will be deeper than that. Especially if you see the proclamation, there is already a criminal penalty which can reach between 7 years and 15 years for this kind of misinformation. So advertisement is going to be a big factor here. So what kind of things should an advertisement contain? The first thing is an advertisement should tell the prospective investor where they can get. It's an advertisement and it's not a prospectus, and it should lead the prospective investors to where they can find the prospectus, and that's one requirement. The other requirement is advertisement should not be inaccurate, misleading, deficient, or exaggerating. So that's another big thing that's going to come up with this kind of with our directive. And the other major thing is it should be consistent with with the information that's provided in the prospectus. So the prospectus itself is required to be accurate, truthful, and it should not omit any material information. So advertisement at the same time should be accurate. It should not be misleading, and it should be consistent with the prospectus. So this process is basically what we get with the registration. So this process it's at the minimum, it's time consuming, and also financially, it's going to be a little bit burdensome. So when I say earlier, it's a balancing act, there are companies that might not be able to meet this kind of requirement. For those companies, the proclamation has already set exemptions from this requirement. So the exemptions provided in the proclamation are for government-issued securities, securities of companies that are declared bankrupt, and the other one is private placement. So those are the exempted securities. And the other thing is the proclamation gives the authority to provide for additional exemptions by directive. So we'll be looking at additional exemptions that are not mentioned in the proclamation, but that will be mentioned in the directive. One good example of that will be offering to qualified investors. So this is basically, and what we have until now is basically about the offering process. Once the company offers its securities to the public and closes the offering, then the obligation will not end there. It becomes a public company, and ongoing disclosure requirement will be set on that company. Basically, any company which has already issued securities, or companies that are going to be considered as publicly held companies, will be subjected to this ongoing disclosure requirement. Why? The reason why this is required is just like the previous offer, the regulation of offering, where we demand disclosure, because we want the public to know before they invest. Even if that offering closes, then there is also the secondary market, where individuals who have already purchased the securities trade their securities among individuals. So the information is going to be important. So we require ongoing disclosure on companies which are publicly held or which has already offered securities to the public. So the kind of information that we require can be periodic reporting, where companies are required. It could be biannually, it could be quarterly, to report to the authority about their finances and that other information that are relevant to that shows the financial position of the company. And also there is going to be a current reporting requirement, which means even if your periodic reporting is not triggered because the time has not been there, still, if there is a major thing that occurs, like example, if there is a merger and acquisition that's being processed, change of the management, or any material change within the company, then that company is required to report this kind of change to the authority as soon as it happens. So this is basically, in a nutshell, what the public offer regulation will look like. So what does it mean to the public offer? It's for the issuing company. It means a process of it gives them the ability to raise capital, and then the converse side of this is it forces them to give up some kind of ownership, and also become subject to rigorous regulatory regime. So this is one thing that happens. I will skip this. And the opportunities as an investor, the capital market and this process, the primary and secondary market, that means liquidity. If we have a properly functioning capital market, that means there will be confidence in the market. That confidence will translate into liquidity, and that's what the market will give to the investors. The other thing is, just like I mentioned, through the disclosure process, what happens is investors will have adequate information to make their decision, and that's another benefit to having the capital market. For issuers, and for service providers, it means job, additional job, and also the disclosure means for this kind of service providers. If we say we have identified 15 service providers that will be acting within the capital market ecosystem. So if we take one, for example, investment advisor or investment bank, the disclosure, the information that's provided through the disclosure process will serve this, will be the basis for their advice that these companies provide. So the material, the historic data that will be collected through this process will be the basis for the investment banking. If we say it's going to be advising on merger and acquisition, it has to have some data on the companies that it's going through the merger and acquisition process, and those information will be available since we're going to collect all this kind of information through this disclosure process. For SMEs, what does it mean? One thing is, Dr. Traun probably might touch on this one in deeper fashion. It means capital raising process through one of their segmented and the segment markets. And the other thing is crowdfunding, through the crowdfunding that they might be able to raise capital. Factoring is another thing that the exchange is considering. It's also a process where SMEs can collect, that can receive money that they might have received in the future, receivable at the present time, so that they will have the liquidity to go about their business. And the other benefit to the SMEs will be, since most of the hopefully the big companies will go through the, access capital through the capital market, and this probably will free up some capital or some cash at the banks that the SMEs might have access to. So that's what it means for the SMEs. And if I may say a little bit about opportunities, currently we have identified around, around 350,000 to 400,000 shareholders exist in Ethiopia. So of this, 95% is in the shareholding is in the financial sector, and approximately 2 to 3 billion Ethiopian birr transaction happens by exchange of share here in Ethiopia currently, with all this, an unfacilitated market. So this what it tells us is there is a big opportunity in a country with a population of around 120 million or above. Only 350 to 400,000 people are involved in the capital market process currently. So you can imagine how, how big the potential is, and how much it is untapped. So with that, I conclude my presentation for today. And if you remember my joke about the pant and the trouser, what I would like you to remember from this presentation at the minimum is we at the Capital Market Authority also know how to crack jokes. So that's the last thing that I would like to say. Thank you much.
I was actually going to take the harder lesson as a lawyer who has practiced in both locally and abroad. Words matter, huh? That's what I was taking. And it makes your life so easy working in Ethiopia, taking those words and putting them into the directive you're drafting. Good luck with that. But please give him one more hand for that presentation as well. So our next presenter, with several years of experience with the IFC World Bank Group, as a private sector specialist and managing multi-sectoral projects, but I call him an academician and researcher at heart. I'll take the other part out. Is currently the senior project manager at the Ethiopian Securities Exchange. Please help me welcome Dr. Tlahon Kassaw.
No. For once, I don't have a presentation, so there's no death by PowerPoint, but as she said, I enjoyed my moment teaching for a while. But welcome again. Thank you very much for all of you for coming. I think, this is the second day of a sequence of workshops that we're doing. For those of you who were not present yesterday, we dealt with our debt market yesterday. So it was a discussion about bonds, money market, and etc. Today, we're mostly focusing on equities, but what Solomon just did is to give you a highlight of what that regulatory environment will be both for equity, but also for bonds and fixed income instruments. So if you have questions around the other side of the market, we will also deal with that perhaps during Q&A. I don't have a presentation mainly because we're trying to do two things right today. One is we're trying to lay down to you what the regulatory environment for issuers, investors, market service providers, or intermediaries is. And in building an equity market that is sustainable, that works, we kind of need two things, right? One is, first, we need to make sure the risk for the investor is manageable, is understandable, is manageable. And that's exactly what Solomon did, right? So we suffered for quite some time, and this is looking at broad opportunities that existed, and we haven't seemed to have utilized, mainly for the fact that when issuers came to the market, there was no perhaps what you call standardized regulatory practice and authority. So our equity market today, as we see it, is mostly limited to the financial sector. So the whole objective is to, of course, expand this opportunity. Second, perhaps the second most critical reason why our equity market hasn't expanded is lack of markets. The numbers that Solomon mentioned, the 350,000 to 400,000 shareholders that you have actually are concentrated on the financial sector, and they don't seem to have an active, working, functioning liquid market. And that's exactly the purpose of establishing an exchange, and that's where you come in, mostly for those of you as issuers, investors, and also service providers. So what do we have then in terms of ESX for serving the equity market? And as usual, we'll have an equity market that has two segments. Some markets have 2, 3, 4 segments. I think my Kenyan colleagues from NCBA, FSD Africa will tell you that at NAC, there are at least 3 market segments. We can talk about that when we open our listing directive, and you will see why those segments are 2 now. But generally, in our case, we'll have 2 market segments, which are main market and SME market segment. So the main market would be your typical large cap entities, your typical bank, or perhaps roughly anything above $1 billion capitalization could fall on your main market, and then anything below would be your SME category. And then, of course, you will have a minimum cap, so you don't accept anyone into that market. So what that market does is it builds a second tier of a standardization process to investors. So when an investor looks at our market, they will see, one, first of all, whether or not that issuer has, first of all, registered at the authority, right? And second, they will say whether or not that issuer has qualified into the ESX's listing requirement. So that listing requirement is a kind of, tier that builds on a standard that says, look, if an issuer is listed on this market, it means it meets certain financial reporting standards. Say the company must have existed at least for 3 years, and it has audited financial reports for 3 years. It has such and such corporate governance requirements. And then a slightly what you call adjusted requirement, listing requirement would apply for the SME segment. So if you are perhaps a company that just established a year ago or 2 years ago, and you only had an audited financial report for 2 years, you may come to the listed market. But we're communicating to the investor that this company does not have a 10-year profitability record. So that's the only goal of this market tiers and boards. So in addition to the equity market, like I said, we'll have the debt market with a standardized debt market. We have obviously, we anticipate a lot of participation from government in terms of issuing long-term bonds, but also we have the T-bills that we're talking about. And yesterday we talked a lot about our interbank market. And both corporates, government can issue bonds into the debt market, including SMEs, to the extent it fits the investors' interest. Then in addition to these two markets, we have what we call the alternative market. So in there, we're trying to do two or at least three things. As Solomon said, one is we're trying to provide a platform for SMEs to raise equity capital through what you call regulated equity crowdfunding platforms. So there, what we will do is we'll provide you, perhaps as an investor, as an Ethiopian, as an individual, SMEs that have been supported, cultured, incubated, etc., where they would be able to somehow receive, small contributions from Ethiopians in Ethiopia and across the world to start their business. So traditionally, that's why it's called alternative market, because traditionally equity markets are considered to be, growth enterprises. So because we do not have a lot of, what you call issuer base, we took it upon ourselves. We have to help some of our SMEs to understand how capital markets function. So what you would imagine happening is now a very small SME, which is just starting, may have a capital of say 5 million birr, 10 million birr, 15 million birr, would by now, if it actually comes to the equity crowdfunding platform, would have to understand how a corporation is governed. They need to have an independent sort of a committee or a board that takes a bit of responsibility out of the owners and also protects the interest of other investors. So it's an experiment towards capital markets. And once they grow, perhaps after they exited the crowdfunding platform, then they will be again supported to come to the our SME market segment. So same still remaining in the alternative market segment, we're trying to also experiment with a platform that is mostly what you say already now in an advanced stage in Asia and Latin America, is where, as Solomon said, a different version of a factoring company. And so as you know, what a factoring enterprise works in a scenario where, take this hotel for an example, it has, I'm sure, a dozen SMEs that provide supplies, vegetables, carrots, etc. And for sure, these SMEs have working capital needs because they keep supplying this hotel their vegetables and supplies every day, but they don't get paid every day. There is a delay of, say, 20 days, 30 days, up to 120 days in terms of payment. And I'm just looking at Yasmin, who've actually led a lot of construction projects at Addis Ababa City Administration. You will have a lot of SMEs providing services to the construction industry who do not necessarily get paid the day they provided those goods and services. So that delay, you have two options as an SME to meet that working capital need. One is, of course, to keep using your resources, but also to go and borrow, but you do not have a collateral that you can show for to borrow at a certain credit. So that delay is actually affecting a lot of SMEs. So the natural response and answer for this scenario would have been a factoring company would be set up, buys those receivables from these SMEs. The SMEs get their cash, but down the line, these margins for these factoring companies have expanded significantly. In other markets, it became more or less what you call at least unfriendly for SMEs. So what we will try to do is to actually help these SMEs come to our online auction platform. And as banks, I was looking at the list of the attendees, so significantly bank presence, right? So as banks, you would be able to buy those receivables from the auction platform. And you'll be confident in doing so because the issuer of those receivables have attested to them in the platform itself. So there will be a triangulated service. So Radisson Blu Hotel has confirmed in that platform that it has issued this receivable, and it will be obliged to pay 30 days, 45 days from now directly to that bank. So that collateralization requirements and risk credit that you think were really a challenge in terms of providing services to the SMEs would be alleviated. The SME will get paid in 24 hours, 48 hours, and then the bank will get paid in a month or two. Usually, you will see that this is more SME bottom-up market, but in other markets, it's also top-bottom. It's what you call reverse electronic receivables factory. It's usually actually the entities such as the hotel or other enterprises that actually outsource their receivable services to the bank. So it works both ways. And in a way, for the exchange, we do not have to work with a lot of SMEs. We just have to work with few large enterprises that have lots of SMEs under them. So what we're trying to do is to draw a line where we're trying to provide a service for SMEs as a startup funding, a working capital, and then gross capital. Only then you would have a sustainable equities market. Because today you'll have this question from the forum. I'm sure you'll say whether or not Ethiopia is ready to have an equity market, because we see challenges in other markets as well. And you will see that other markets have started to venture into this kind of alternative markets, mainly because of this, because of the need to develop the SME and the issuer base. So that's what I think. Second, I would say, then why are we here? I think we have a very, interesting agenda. A lot of people, a lot of brilliant people that will be telling you their experience in other markets. I think the takeaway from you, and for you, especially for our Ethiopian colleagues present in the room, is three things, right? One is we look at this market as an issuer. So that's why you needed to understand what Solomon was talking about. If you plan to come to the market, you need to understand what that public offer directive is and what process it entails. So for the exchange, we'll tell you you have 2 or 3 avenues to come to the market. One is for a public company that already exists in the market. All you have to do is perhaps take an avenue that we would call listing by introduction, so that direct listing. So you're not issuing or offering or asking for new fresh capital. You're just seeking an introduction to the market to provide liquidity in market to your issuers. So we would assume that listing process for listing by introduction is not going to be a big deal for most of the banks, because you meet most of the issuer requirements. You're a public company already. You have financial reporting standards. You have corporate governance, etc., etc. Which is more or less in line with what the draft directive envisions. For an investor, looking at the market is interesting because, one, you have to see who is coming to the market, right? We used to think when we started this job, we said, there is a lot of appetite for capital in Ethiopia, but the other side of the world, which is the investor side, the supply side, we thought it's very thin. It may be thin, but you look at two things right now as we speak today. One is, unlike other markets, we do not have an institutional investor base, and that's what we say on paper. But we're also telling, I see a few colleagues from FST Ethiopia, we're also telling our pension fund to kind of modernize, have a different investment strategy, start investing on some other instruments other than government debt. But then if you ask the pension fund where they would go, they don't have a functioning working market. As we speak every day, so the total asset of our 2 pension funds is about 300 billion birr, above $5 billion. As we speak every year, there is about 35 billion birr fresh money coming to that pension fund. If you ask them to invest even at least 10% of that fresh money, because you would expect as a pension fund, you would invest anyway. This is also the same thing, the case in other markets. significant majority of the investment will be on government instruments, right? Evans would attest to this. But if you actually encourage them to go to the equity market, where else would they go? That 10% is about what? 5 to 7 billion birr, right? So they would be buying new bank every year. So it is what you call a vicious circle, and it's a chicken and egg problem. So both as an investor and as an issuer, we have an opportunity to create a market that helps both of us. And pension fund is dear to my heart because down the line when you retire, that's the only thing you're getting. And you would want them to invest on something else better than government equities because their returns are not really real when you invest in government instruments today. So that's one. So as an investor, I think beyond the pension fund, some of the banks here for sure, and this is something you've brought to our attention, you are interested in setting up some funds, money market fund, equity market fund, or diverse funds. You would all of a sudden be looking at instruments in the market, trying to invest on liquid instruments. And that's why you have colleagues from NCBA in terms of helping you understand what that market looks like. So you would also be important, and it's critical you understand who's coming to the market. Last but not least, of course, is what is the environment for market service providers? What's the environment for fund management, brokers, dealers, investment advisory, etc. As I said, we have a limitation in terms of bringing the issuers to the market. And the issuers will need your support. That's exactly what an investment bank does, right? So the advisory leg of this conversation is very important. The exchange cannot survive without issuers. Issuers cannot come to the market without that advisor. And that's the whole objective of standardizing the regulatory environment. Later this afternoon, you'll hear from Elsa in terms of where the Capital Markets Authority is in terms of providing licenses to those service providers. So all in all is to say, look, we need 3 or 4 what you call key players in this market to build the market. One is the authority. The other one is the exchange, issuers, and investors. And in describing what ESX is all about, we're, I think, also telling a story. As we speak, we're raising capital. So you would be interested in reading our information memorandum. That's my sales speech. But you would also need to understand and perhaps project and plan and really critically analyze what that market holds for you. And here are the colleagues from everywhere and every part of the world to help you understand that process. And with that, I'll say thank you.
Thank you very much. You actually gave 8 minutes to the next team, who I'm sure is going to need more than that. So before we jump off to coffee, we have one more very interesting presentation. The presentation is from the NCBA investment banking team, who have agreed with me to do 2 things, right? One, they will let you go at 10:30 to have your amazing coffee. Yes, they're shaking, okay. The second thing they have agreed on is that they would teach us a game of roulette running between the team Morris, Mr. Morris Opio, and Mr. Gerhard, who would be playing the roulette game as the true Kenyan runners are. So they would be presenting the presentation together. So I will call upon Mr. Morris Opio, Executive Director Advisory, to take the starting line and then hand it over to his teammate afterwards. So please give Mr. Morris a very warm hand. I promise I would move this stair to my side.
Thanks. I think for purposes of my presentation, Mr. Solomon and Dr. Tilahun has actually made it very much easier. So I will be skipping some of the slides so that just enhance on sections which might be quite crucial. Now, for the purposes of listing companies on an exchange, there are several ways. One, you can list via an initial public offering, which Mr. Solomon had actually talked about. And just to recap on that, it is where a company approaches members of public to subscribe for their new shares by paying particular price and a quantum of the allocations that they look at. And on listings by introduction, that's where a company is already has been formed or is in existence, as Mr. Solomon mentioned earlier. But the purposes of listing by introduction is just to do a price discovery and be visible within the marketplace. The other two forms of listings, which were not mentioned earlier, could be a cross listing. And in a cross listing scenario, that's coming into market whereby you tap into another jurisdiction. A good example that I can give out for a company that operates today in Ethiopian market, that is Safaricom. It is listed at Nairobi Securities Exchange. If Ethiopian Securities Exchange is up and running, they could potentially opt to then list in this market. And by doing so, they can equally raise capital within this market without raising it in Nairobi. And lastly, on that segment is a reverse listing. A reverse listing comes in a scenario whereby you are a private company, but there's already a listed entity within the market. As a private entity, what you do, you buy out the entity that is already listed. Effectively, you become the new listed entity. There are several benefits to a listing. I'll combine them. It's not only due to an IPO. Whether you list by introduction, you do reverse listing, you do cross listing, the benefits to the issuer cuts across. One is that brand visibility. You'll always be known in the market. You could have an avenue of raising capital. So if it's a new money that you're seeking up, that will be an IPO. If you're looking to raise money into the future, you could do it through a rights issue, for an example, which becomes the alternative source of funds. And it's not only the equity capital, it could be debt, as Solomon mentioned much earlier. To the investing community, of course, it gives you more asset class. And I think we talked about this yesterday, portfolio, which Paul mentioned passionately, and also gives you the liquidity. Imagine if you're in a company that is not listed and you have 10 shares and you're trying to exit. It's not possible to really exit. But if there's a well-functioning market, you should be able to find an avenue to then dispose of those shares and get your cash back. Now, for a listing to really happen or to bring a security into market, which is a primary function of the market, there are several parties which have to really come together to make this happen. And that's what creates a market. Telaun said, having ESX, that is just a platform. You have got ECMA to provide you with the regulations and the sets of aspects that you really have to follow. You have the company, which must be guided and coming to the market. So the regulator, the investment bankers will then guide that entire process. Then ultimately, you have got the investing public. Now, the purpose of the investment bank under this in terms of raising capital is to guide the issuer to comply with the set regulations which have been put in place. Mr. Solomon talked about getting disclosures. It is a duty of the investment banker to then assist potential issuer in terms of complying with all those sets of regulations and to work with the potential issuer to ensure that the disclosure meets the standards which are required, and also to ensure that all the risks within that company is made to the public so that the investors are not coerced we talked about investor protection. So the investor needs to have all available information to make a decision. In terms of coming to market and to have all those functionalities, one, on the issuer side, they have got their governance structures. And the governance structures, they'll have to seek their approvals, whether it is from their board. And if it is equity capital raise, then they have to go to their shareholders and seek the shareholders' consensus that we can go out to the market. Now, in ensuring that the prospectus or the fundraising documents meet all the disclosures, then advisor to the issuer will ensure that he performs several duties. One is to do a due diligence on that company, and it has to cover all the legal. You have to ensure that the company is well incorporated and all aspects of running that company is as per the law. You have to then look at the commercial viability of that business. So you have to look at how are they performing, which segments are they serving into the marketplace, and in terms of the financials, are they meeting all the set standards which are required from a purposes of disclosure. Once all that review has been done, then you have to carry out a valuation exercise. I'll combine this slide with the last slide, which I'll not have to repeat myself on setting up a valuation. There are two paramount aspects that an advisor will be looking at. One is carrying out a valuation on a market multiple basis, or sometimes what we refer as relative valuations. And in carrying out a market multiple valuation is a scenario whereby if you take a multiple, for example, I know if there are bankers here, you'll be familiar with the book value, right? Which is just your shareholders' fund. So if you have got a price to book, that's a market multiple which you can use within financial sectors. So what you'll be able to do with that parameter is to look at if there are other listed entities within that particular segment. If there are banks, there could be 5, 6, 7 banks. And you'll have all arrays of these individual multiple. If it's a price to book, bank A, bank B, bank C, bank D. And you'll either have an average of that, or a median of that, or a mode of that. And applying that into the company that you're valuing with its book value then will drive for you the value of that entity, okay? Others could be price to earning, which is just your profit after tax into the price, and of course, the fundamental valuation, which is discounted cash flow methodology, which you're looking into the long term of the business and saying, this business on year X, they are performed Y. How are they going to generate their revenue for the next 5 years? How will their earning before interest, tax, depreciation look like? How will their profitability look like? Then you discount that value to the present by a cost of equity and get the value of that business. Now, once that has been done, you'll be able to then disclose it to the potential investors under your prospectus. So you have to give what was your basis of pricing. Sorry. What is your basis of pricing that you have carried out within that company. Then lastly, of course, would be on your placement methods, whereby you'll have to go out to the investors and seek the fundraise. I don't know whether this power has gone off. I can just proceed, and maybe the slides will be shared later. So that is the first step of bringing an entity into the market. So the primary market, all right? Now, once you have had a primary instrument come in, then we look into the secondary market. Now, what does the secondary market serve? Dr. Solomon had talked about continuous obligation. As you operate in a secondary market, that becomes part of what you'll be carrying out. Now, for the secondary market, you're looking at two aspects. If an exchange already is in a place, you'll be able to trade out listed securities, either go through your brokerage, proceed. Yeah, that's fine. So, as talking about the secondary market and how that works out, so I'll only focus on securities exchange because that's what we are creating in this jurisdiction. The other market is over the counter, which is just a semi-market, not as liquid as your securities exchange. And last one is the auctions market, whereby it's just a competitive bid process. And that's more or less from myself. Let Gerald then demonstrate a couple of case study so that it combines what I've talked about and give you some of the example from actual trades that we have. So Gerald, maybe you can proceed.
Good morning. So before I get into the slides and just to give a few examples of transactions that have happened within the East African markets, one of the discussions that is always there around our markets is around market depth. And market depth is about the ability of a market to absorb a relatively large order without significantly affecting the price. So what has been happening within the East African markets, and this is especially under the East African community, they have been focusing on integration of our East African markets. And investor participation becomes very important. So for purposes of the East African markets, an investor within East Africa is actually considered as a domestic investor. Anyone outside the East African region is considered a foreign investor. And what this has done, it has enhanced participation of investors within the East African markets. And a good example is when Safaricom did their IPO, one of the top 10 investors was actually the Rwanda Social Security Board. It's the pension fund, the main pension fund in Rwanda. So going to a few examples of listings. So I'll start with this group called Equity Group Holdings. It's one of the listed companies in the Kenya Securities Exchange. Equity Holdings listed in 2006. It was a listing by introduction. It had some private equity investors, Helios, IFC have been there. And one of the things some of them were looking for is how do we exit? So when they listed on the exchange, they were not looking to raise capital. They simply introduced those shares on the exchange. But as something interesting has happened to equity, because right now when you look at the Kenyan banking sector on the exchange, they are the largest bank in terms of market capitalization. When I look at the current exchange rates, market capitalization for equity groups sits at around $1 billion. For the last couple of years, they have been doing acquisitions of banks in Rwanda and the DRC. There's one current transaction that is closing right now where they've just bought a bank in Rwanda. Last year, they did a transaction of a bank in the DRC. They never paid any money, hard cash. Most of the transaction was giving equivalent shares that are listed on the Nairobi Securities Exchange. So it just gives you an avenue of how banks can be able to continue growing and at the same time utilizing the shares that are on the exchange. The other critical thing is for you to do a cross-listing, you have to have a primary listing jurisdiction. So when they listed on the Nairobi Securities Exchange, it enabled them now to cross-list to Uganda and to cross-list on the Rwanda Securities Exchange. Another example is Safaricom. Safaricom was an IPO, but the objective of Safaricom, which could be an objective of EIH, is Safaricom was really government giving out, selling a percentage of their shares on the exchange. There was no capital raising for money to get into the company. It's been a very successful company in the Kenyan exchange. From a market capitalization perspective right now, they sit at almost $5 billion. It's a favorite for foreign investors wanting to get into the Kenyan capital markets because how the company has grown. They started with an offer price of around 5 shillings a stock at the point when they were listing. And right now the company is at almost 17. And with the issues that have been there in the global markets, it's actually a reduction in the value of the company. It had gone to a high of around 36. They're already in this market. We've seen some of their shops here. They are not raising any equity in Kenya to get into this market. They have basically been recycling the funds that they have been getting. Another group is called INM Holdings. INM was a reverse listing. So there was a company on the Securities Exchange that was called City Trust. What INM did is they actually acquired City Trust via a reverse merger. The structure was changed because what happens is that, and this is actually the structure that I want to talk about when you look at banks. Banks in Kenya have used the holding structure for purposes of listing on the exchange. The entity that is listed is the holding company. Every other entity dependent on the country is actually a subsidiary of the holding group. So if you look at, like I talked about Equity Bank Rwanda is a subsidiary of Equity Bank Holdings. So it's the holdco that is listed. So INM Holdings was a reverse acquisition, a merger happened, and what happened is that the main City Trust had to change their name to INM Holdings. And subsequent to that, because when they listed, there's enhanced, Maurice talked about corporate image changing, people have more trust in the company, there's transparency, there's matters to do with sustainability, so they're able to come to the market and raise additional products because market knows them. So they've been able to do a medium-term note. They've been able to raise $100 million as a medium-term note in the Kenyan exchange. The other one is KCB. This is the largest bank in Kenya from an asset perspective. They are also cross-listed on the Dar es Salaam Stock Exchange, Uganda Stock Exchange, and the Rwanda Securities Exchange. Let me go to some. What we did is we took statistics from our Nairobi Securities Exchange. This is as of 30th June. I've not changed anything. I just wanted to take you through live what is actually happening in the Kenyan Securities Exchange. So we have around 13 sectors. You can see starting from the top, we have the agricultural sector that has got around 6 companies. We have automobiles sector, it's 1 company. Banking, you can. Yes. Okay. Okay, perfect. Okay, let me go straight from the top again. So this is just statistics as of 30th June on the Nairobi Securities Exchange. I talked about 13 sectors. I'll briefly go through these sectors. So the first one is agricultural sector. We have around 6 companies. Maybe just for purposes of ease of understanding, is that when they're reporting, the first column, which is they put the last price for trading, they put the number of shares that are available on the exchange, they put market capitalization, they put earnings per share, dividend per share, which is your DPS, they put price to earnings, that your PE ratio, and lastly is your dividend yield. And on the right extreme left, I've actually put the market capitalization from on a USD perspective. So 6 companies on the agricultural sector. We have 1 in the automobile sector. We have the banking sector stocks. These are a total of 11. Notably, Bank of Kigali, which is the largest bank in Rwanda, is actually cross-listed on the Nairobi Securities Exchange. You actually see them right, that's the second one. Another key notable pick from this is the largest banks from a market capitalization perspective is the local banks. You'll see Equity Bank, it's number 4. You'll see with a market capitalization of almost $1 billion, followed by KCB. You've seen I&M Holdings there. You've seen NCBA. NCBA is there. NCBA is the last bank to do. It was actually across the CBA. It was a merger of CBA and NIC. NIC was listed on the exchange. CBA was not. So what they did is there was a swap where CBA shareholders were given equivalent shares in NIC, and CBA became a subsidiary of the bank. The other one, we have your commercial and services sector. You can see the number of companies there. We have the energy and petroleum sector. You'll see that we had some preference shares. So other than ordinary shares that will be listed on the exchange, we can also do preference shares. Like our power distribution company, KPLC, had some preference shares. Another notable cross-listing is Umeme. Umeme is a power distribution company in Uganda. When they're looking to raise additional capital, they tapped onto the Kenyan market because our fund managers, like Paul, are looking to diversify their portfolios. So they're looking to other markets where they can actually invest their capital. You'll see the insurance companies. Again, notably, the largest one is Jubilee, which is actually a local insurance company. This is something else which is notable, is we have an investment services sector. The only listed company here is actually the Nairobi Securities Exchange. So we're also hoping that when ESX is established, they will actually list on the exchange. Then we have manufacturing and allied sector, and there we have around eight listed companies. There you have Safaricom, it's under the telecommunication sector. You can see the last price it was trading at is at around 17.7. It started at a very low price. And you can see market capitalization is almost $5 billion. Then we also have real estate investment trusts. We have two. We have Fahari iREIT and we have the Lab Trust Imara REIT, which was just recently introduced onto the exchange. And we have one exchange traded fund, which is the Absa Gold EFT. So in a nutshell, that just wanted to paint a picture of the Kenyan exchange, and you can see what is happening in East Africa around regional integration. There's an East African capital markets protocol that is being developed by the ESC. We would encourage that when ESX comes into the market, they see how they can plug in for us to be able to improve the depth of the Ethiopian Securities Exchange. Thank you.
Thank you very much. That was really brilliant. I think we have a few minutes, but because I'm gonna call you back exactly 1:45, I need to check my time now, huh? To 11. So because I'm gonna call you back at that time, I think the coffee is ready, tea is ready, but please be back on time. Huh? We should have given you 15 minutes, but we're giving you 25 minutes with the gracious time saving done by the NCBE team. So please give them a hand and then have your coffee. Okay. We're all back. We're all almost back. Let's just say that. But the house was full, so I think we just kickstart with the next sessions. And we have like a 15 minutes punctual people waiting for the presentation. So I'd call upon Miss Ivan Jugwan, my God, head of trading. And I practiced this, can you believe? 3 times just not to do this. Head of trading, NCB Investment Banking, to walk us through the practice in equity brokerage. So the hand is missing. Did you have coffee?
Thank you. Thank you very much. I learned a new word. Dena Derachu. So good to see you back. Oh, Amesa Gelena who. Thank you. Yeah. So she said my name. In this conference, yesterday we were told there would be an exam, so I've been waiting for it. I was reading most of last night, but I took this from yesterday's session. The most repeated word in the conference has been markets. And in the local language, markets is Gebea. Yeah, and I don't see it on the title. So maybe it should be capacity building workshop for Gebea, Ethiopia, Gebea. Gebea, Ethiopia, Ethiopia, Gebea. Yeah, and I'm here to speak about trading, the role of an equities trader. When you go to the Gebea, there's always a negada, isn't it? There's a negada. The market cannot, Gebea cannot go on without the negada. So I'm here as a negada, and as a negada, you need to be aware of the theme of the conference, which is inclusivity, connectivity, and sustainability for wealth creation or wealth growth, isn't it? So as much as you're selling your product, you need to be very conscious of the investor, and you have a policeman, the CMA, who's really taking care of the investor needs. So for you, as a negada, you need to be aware of that. Sell the right product at the right price and to the right customer, or to meet the needs of the customer. And it's not moving. Okay. Okay. Thank you. So my slides are very few. It will be a discussion. So we'll describe who the negada is, or the trader is. This is an individual who buys and sells shares. They can also be selling bonds. But for the purpose of today's session, we're talking about shares on behalf of the investors or the customer. So today, a new term has been introduced, the customer. In this particular Gebea of ours, the customer tends to be called the investor, okay? Because they have given money to the company. So we'll substitute the name customer for investor. And the negada seeks to execute the instructions of the customer efficiently and according to what the customer has indicated, okay? And as they execute, they need to give the customer information as to why they should be buying this. That is the valuation bit. Why should we be buying an Amhara bank and not Dashan? Okay? Dashan, Amhara maybe is valued better than Dashan. You need to have that valuation and present it. And the Capital Markets Authority will continuously assess if you're doing the research so that that information is available to the customers. so that when they're making their decisions, they're well aware of it. So that by the time the customer comes to the Gebea, you, the intermediary, have already done your work, and it's now just to execute as a trader. Who are the stakeholders in this Gebea of ours? We have the Capital Markets Authority. We have the Securities Exchange and the CSD. We have the investors. These are the customers. We have the research analysts. We have the back office and IT. I want to emphasize the need for research analysts because in a previous presentation, you had the CMA said they will authorize the transaction, but they will not advise the customers as to whether that share is good or how it will perform in the future. That work then falls on the stock brokerage or the investment bank, and the trader is mandated to share that information with the customer, okay? So research analysis is very, very important to understand the company and communicate it in a language that is easy for the customer. There was someone yesterday who emphasized the need for inclusivity. Right now we are in Addis, but for the trader or for the Negada, your customers will come from Adama, Bahir Dar, right? Jigiga, Gondar, Jima. Be open. Let's not have this product focused on the Addis area. I guess the larger population is outside Addis Ababa. And how do you speak their language? You may have to translate all this into Amharic. You may have it to speak it in the local radio stations, you know? And the research that you derive or the information you derive about those companies has to be broken down to the level of the investor. And we said that there are 350,000 to 400,000 customers right now trading on the OTC. This whole ESX will be a new product to them. How do we break down that information to their level so that then that capital can come to the market and help boost the businesses within the Ethiopian economy? The language we use is very, very important, broken down to their level, okay? Back office and IT, of course, this is the processing bit and the settlement, but I would also like to mention that even as ESX sets up, these are also career growth opportunities for the population. We'll offer jobs to the population. And as stakeholders, you can start preparing and planning for that. Educate the staff. You yourself can set up the business to take the project forward. What are the potential risks when one is trading? For the Negada, what do they have to be aware of when they are taking their wares to the market and advising the customer? The geopolitical risk. For this year and last year, most of Africa, we've been affected by what has been happening in the markets, the developed markets, the dollar issue affecting all of us. In the Kenyan market, we've had the foreign investors exit. A security like Safaricom, which had about 40 to 45% foreign investors, they've sold everything. Right now, local investors own about 92%. They've just been selling and taking down our prices. Why? Because there are issues happening around the globe. So be very conscious of that as a trader, as you come in the morning in the office, what is likely to affect our market. There is the regulatory risk, the government regulations that may affect listed entities' profitability, like in Kenya, in Ghana as well, I think in 2021, where a finance bill that had heavy taxation on companies that then reduced their profitability, which means their share prices will come down and the investment value of the customer goes down. There's the interest rate risk. This was exhausted in yesterday's session when we were speaking about debt. For a company where this comes in is that companies have borrowed money from individuals. And also government borrows money from corporations and from individuals. When the rates go up, people will want to invest at a higher rate yet the company cannot afford to pay that higher rate. So the company is devoid of cash, isn't it? So these are the key risks that will affect the valuation of a company. And so when we come to the daily activities of the Negada in their Gebea, when they wake up in the morning, I hope they had a good breakfast. When they come to the office, they need to review what is happening in the globe, what's happening regionally, and what's happening locally. And then follow up on the company news and try to interpret what is the expected impact of those news on our share prices today. You're in a team, you need to trade with other traders on behalf of investors. You need to brainstorm as a team, just what happens in a treasury function in the morning in a bank. And then of course you review what had you done yesterday and what was pending. And immediately after that, you make calls to your investors, to your customers, you source for business and update them on market news. In Kenya, in Nairobi, I haven't seen hawkers in Addis, but in Kenya, there are some hawkers who are very innovative. So they've audio taped themselves. So they come with a small radio and they keep announcing, Amhara at 20 bir, Amhara share at 20 bir. The radio keeps repeating. So for you as a trader, you need to keep calling your customers and updating them regularly of the product that you have, because the product may not just be offered by yourselves. The customers may actually have requested for it. And then of course you ensure that the trading system is ready for the day by liaising with the IT and the Securities Exchange. In our market, the trading system is provided by the Securities Exchange, but with a lot of collaboration with the investment banks. So you have a system provided by the Securities Exchange, and internally you have your system which you use to confirm to customers. And in most instances, your internal system can be tweaked or can be changed so that customers can access trading through their mobile phones, through their laptops, etc. So that then we are very keen on the issue of connectivity. Instead of someone coming all the way from Adama to Addis to place their orders or to make a phone call to the Negada, why don't they just do it from the comfort of their home? And as Africa grows, we are headed towards the developed markets bit where the role of an investment bank now will just be to advise customers. I'm buying Amhara bank shares. Why Amhara and not Dashan? Because now the customer can self-service, from their mobile phone, from the comfort of their home. And then after, so this is before the market opens, what the trader needs to do. And any businessman will do this, essentially. Then during the trading session, when the market is open, keep updating yourself on what's going on globally, because we have time difference aspects across the globe. And the fact that we are heavily impacted by what's happening in the developed market, and the US will be at work at 2 p.m. Eastern African time. You need to know from evening what's happening or what happened yesterday, which is our night time. And of course, follow up with investors for potential business. You need to liaise with other market players or your competitors, because sometimes you may not have the position the customer wants, but your competitor has it. Execute the trade as per customer instructions. And if any errors happen during the trading session, you're advised to correct it before the day ends. So this is how the Nairobi market looks like. Our market opens at 9 to 9:30. We have what we call a pre-open. At 9:30 to 9:31, a 1-minute session of price setting. It's an auction, what we call a raffle. And then at 9:31 to 3 p.m., the market is open for continuous buying and selling. So as a trader, you're not just seated there looking at the screen, you're engaging your customers. And when the market ends, obligation to all customers, confirm all trades to them, send them the trading summary to the back office and also to the customer sometimes, and then compute how much you have made for that day. Because the reason you're trading is to make money as you meet the customer needs. But how do you make money? as a trader or as an investment firm or as an investment bank or as a stockbroker, I've used the Kenyan case. Our commission structure is as follows, but I've used Amhara Bank and I have assumed a share of Amhara Bank goes for 20 brr. So the trader makes money through the brokerage commission. 0.36 is statutory levies. So the broker or the trader works very hard to increase the 686. The 686 brr. So that's why you have to continuously engage your customers. And as I mentioned to you, I took a case of Kenya, the commission structure, but used an Ethiopian company. And as I was reading about Ethiopia, I came across this proverb. We like it in Kenya. There are no better witnesses than your own eyes. Okay, I don't know how you say it in Amharic, but it's a very famous proverb in Kenya. We use it a lot. After market close, as a trader, you need to discuss with colleagues on the trading desk about the day's experience. What deals did you miss? Which ones did you get? Can you get more business for tomorrow? Call back your investors, tell them about the opportunities that are available, companies that have announced their results, etc. And now for the trader, what makes an equities trader successful? Number one, continuous education. I guess for as ESX sets up, it will be maybe initial education, but once you have the initial skills, continuously read wide, get certain certifications like CFA, the CC, etc. Good organization, communication, and budgeting skills are important. Have excellent customer experience or customer service. Be a networker with stakeholders through conferences, meetings, and calls. And of course, be a good team player, isn't it? For any Negada, I guess this applies to all businesses, right? A good name is better than a good perfume. And I learned that it is said, Torusem ulem toruno in Amharic. Yeah, take care of your name, ulem, because more customers will keep coming back to you. Thank you.
So whoever said you need to learn any language between the age of 1 and 7 has been proven wrong. That scientific finding needs to be revisited all over again. But thank you, Eva, for that presentation. I think the next session is going to be, both of them are going to join us virtually. I'm looking at my amazing tech people to check if they have joined. Okay. So I think first off is Mr. Stephen. Mr. Stephen, thank you. Maleche, Head of Research, Asset Management at All Mutual Investment Group. He's laughing, I was struggling, and I've been helped by a colleague here. So Mr. Stephen would be sharing with us the experience in equity market development and fund management. I hope you can hear us.
Yes, I can.
We do need to test. Fantastic. We can hear you as well. So let me give the floor to you, and I'll take it back in true manner on time, huh?
That's fine. Good morning, all over in Addis. Apologies. This was supposed to be my colleague's presentation, Anthony Muithiga, but here I am. Apologies from him, and also greetings from him. I'll just share my screen. You can see my screen?
Yes, if you could put it on full. Yes,
Slide
now
show.
it's visible, yeah.
Yeah, that's good. Right. So I'm just going to talk to you about asset management and then talk about equity markets and equity funds. And I'll focus much more on our Kenyan and East African experience because we are active in two main markets, Kenya and Uganda, and a little bit in Tanzania and Rwanda, although those markets are still not fully open up to asset management. That's what we're going to talk about. So when we talk of asset management, what are we thinking about? We tend to think of asset management. It already happens in Ethiopia, but most likely you're doing it in a non-formal way, in that you would find an insurance company will have assets, deposits, government securities, and they would be managed by a sub-department of that finance, of the finance function. Or you'd find for some state corporations, they actually have a department that manages their investments, their property. So that's still a form of asset management. The key difference between that and a market which is formalized and where you're going to is that you will split control of the assets. So the person making the decision, should we place a deposit, buy a share or a bond, from the person who actually holds the actual assets. So you would have custodial banks that which would hold those assets on behalf of the organization or individuals, or in this case, even when you get unit trusts, mutual funds. That's how our financial landscape looks like. Kenya is a multi-regulator landscape with several regulators looking at different segments of the market. So you have under banking, central bank, using the Banking Act. Under insurance, you have the Insurance Regulatory Authority, which looks after life insurance, general insurance, and composite insurance, plus the network around it, which is your brokers, your loan adjusters, all under the IRA Act. And we fall under, as asset managers and stock brokers, we fall under the capital markets, and we are regulated by the Capital Markets Authority, which uses two principal acts, the Capital Markets Act and the Central Depositories Act. So the Central Depositories Act simply is an act that enables most securities to be dematerialized. So you, instead of getting a certificate every time you buy a share, you get a digital entry that says you actually own a share that's listed on the exchange. And that's what regulates asset managers, custodians, stock brokers, and corporate advisors. If you look at a market like Ethiopia, corporate advisory definitely is there. And I think it's more likely you'll find Ethiopia is going down the same path Kenya had in the early 90s. So in the early 90s in Kenya and the late 80s, there were corporate advisory arms, but most of them sat in the large commercial banks because they found they had clients who did not need 3 or 4 year loans. They needed more equity than short-term loans, or they needed loans, but loans which be more than 5 years out, 7-year loans. So what happened in Kenya is that most of the large banks, the likes of Kenya Commercial Bank and Barclays, then set up corporate advisory arms, which would help clients structure their balance sheet and issue securities. So they would issue a corporate paper or a corporate bond, and the sole buyer of that particular bond structured by the corporate advisory arm would be the bank, which instead of giving a direct loan would buy that corporate bond. That bond would run for a longer term than the loan. Then in Kenya, we also have what are called credit unions in some market. I'm not sure how it's called in Ethiopia. In Kenya, we call it savings and credit cooperative organizations. Very strong. Those ones are run under the SACCO Societies Act. And we have some of our cooperative societies which are deposit taking. So they almost operate like banks, can give you a loan, can give you all the way up to an ATM card. Then we have pensions. So unlike some markets like Nigeria, in Kenya, you can be one single manager can be a manager of non-pension assets and pension assets. You do not have to form two separate subsidiaries. However, to manage pensions in Kenya, you must be registered simultaneously by the Capital Markets Authority and the Retirement Benefits Administration, RBA. So there you have the fund managers, such as us, administrators, and custodians. This is how the asset management industry looks like. Just around 1.2 billion US dollars with various managers in it. So when you look at it, and this is more of the pension and corporate business. So if you look at it, pension and corporate, you have several managers who are big: Sanlam, Gen Africa, Old Mutual. The other side of the business is the asset management business, which is the unit trust. This is where you have your money market funds, the equity funds we're going to talk about, bond funds, and other special funds. You look at that, the big market leaders are NCBA and CIC are the big market leaders in this market. And this is about 1.15 billion US dollars. It's been growing significantly so. However, given how Kenya as a market grew, Kenyans have not been too enthusiastic about equity funds. And that's not been because of the underlying, it's been because of how the equity markets grew in Kenya. So unlike most countries, the equity markets in Kenya started with individuals being encouraged to buy and sell shares in their own personal capacity rather than invest in shares via a fund. So if you look at the next slide, that same 1.15 billion market, when you look at it in terms of where the assets are, 75% of the market is in money market funds. And if you look, equity funds are a small proportion, just 1.84% of the funds. We don't have exchange controls. As such, people are allowed to keep their money in dollars, so you can opt to save in US dollars or in shillings. So it gives us a very interesting situation like right now. So right now, Kenyans have more money sitting in US dollar deposits than the official reserves that the government has at the central bank. So it's an interesting situation. So that's 4% of the market. So you can see it's 1.84%. Reason is Kenyans were allowed early on to buy shares individually. They didn't come to the market via products and funds. So what happened is they believe when they need to get equity exposure or buy shares, they can buy individually. And over the last 15 years, we have had successful public listings where government privatized state corporations were listing on the exchange. The most famous one, which will be a name known to yourselves over there, will be Safaricom. That was listed on the exchange, and it was listed at 5 Kenyan shillings in 2007. Today, the price is 17 shillings. That is 3 times up. The price has gone as high as 40 shillings. That's 8 times up. So the retail investor, everyone, even the ordinary person on the street, has gone through a phase where they know that buying shares can make you money because they put in 100 shillings and came out with 300 shillings. But they also know it can lose money because they have had situations whereby they have bought shares and the market has not done well. They have lost more than 50% of their money. So that's the layout of the land of how we sit in terms of the regulation and where our equity funds sit in relation to the market. And I'll just talk about where the industry is as asset management. So we have the two sides of it, the pension side of the business and the corporate side, and the unit trust side of the business. So we think this business will keep growing. One big thing is that we have population growth. And as more Kenyans join the working population, they're going to keep using savings and investment products. What's happening across the world, even in Ethiopia, if you notice, is that we're becoming more formalized. So if you look, 15 years ago, anyway, you went around Eastern Africa, if you wanted to buy something out of a shop, it was a kiosk on the shop, on the roadside, or just a standalone grocery shop. If you look today, most of the key things you buy, milk, bread, soap, you buy them out of a supermarket. So that formalization has also come to financial products. People now are starting to be paid formally, use formal channels such as bank accounts because they can now get loans off it. So as the population grows, we see that number growing. And the second thing that's really growing it is client sophistication. So in Kenya currently, consumers have come to realize, I'd rather not keep my money in a bank savings account. I'd rather keep the money in a money market fund where I can earn a higher rate of interest and take out my money at any point and earn interest for those days that it's sitting in a money market fund. So that's client sophistication. So it grows a lot of the products that asset managers develop. And the third thing is innovation. Asset managers across the board are continuously developing products that meet client requirements. So to meet the requirement to save and borrow, most asset managers allow you to use your unit trust funds, your mutual funds, whether it's an equity fund or a money market fund, as security for borrowing. So how it works is that a bank approaches the client approaches a bank and says, I want to borrow, let's say, a million Kenyan shillings. And he holds 1 million shillings in a unit trust fund, let's say an equity fund. The bank says, against equities, we can only lend you 30% of that money. So the bank says to the client, we can only lend you 300,000 against your 1 million that you have. The client agrees, and the bank instructs the asset manager, please place a lien against the client's holdings of 300,000 in that equity fund. And then the client gets the money with the equity fund acting as security. So like all industries, there are several challenges. One, level of fees. So if you look at the level of fees in Kenya, because of a lot of competition, Kenya has more than 23 fund managers. If you look at unit trusts, the pie chart there looked very colorful, but there are more than 15 money market funds. So some are not even on that list because they are so small. So the fees in Kenya for asset management have gone below 0.5%. And that is active management, where you meet a client, rebalance the portfolio, look at the portfolio every day. It's not an ETF. It's not an automated platform. So the fees have gone to almost as low as for automated platforms because of competition. So that's one challenge. The other thing is disclosure standards. The Capital Markets Authority has tried to put basic disclosure standards, but the problem is some of the players follow the, would you call it, the letter of the law, but not the spirit of the law. So simple one is, if you look, all unit trusts, whether equity funds or money markets, have to publish their returns every day in the daily newspapers. So you're not too sure if you're looking at all returns that are net of fees and gross of taxes, or some are gross of fees and net of taxes. So in terms of calculating performance there, we are okay, we are uniform, but how we disclose it, it's not so clear across a variety of unit trust funds and products. So those are the two challenges facing us. I can move on to the next part, just talking about the market for securities, equity funds, and stock market indices. So this will be, yes?
We might be running out of time, so if
Yes.
you could just wrap it in 2 minutes.
All right, that's good. So the market for securities, we're looking at it, we have listed and unlisted. So as you grow the market, it would make sense to even start with unlisted ones, and as you get the exchange up and running, transition them into the exchange. That's how an equity fund works. So you have the investors here, they put money into the equity fund, and then the equity fund puts the money into the custodial account, and you have the asset manager who gives instructions to the custodian on what to buy and sell on the equity fund. So he says, I want to buy 100 shares of Kenya Commercial Bank sends the instructions to the custodian, and the custodian then puts the instructions out to the market, and they come back into the fund. So on indices, there are two indices: market capitalization weighted and price weighted. Price weighted tend to look at market capitalization, just the price of the share times the number of issued shares. So it's affected by large companies. So you find large companies have a higher weighting in a price weighted index. So if their price moves, it affects the index more than if smaller companies move. So like in the Nairobi Stock Exchange, if you look at it, the price weighted index, Safaricom is almost 40% of the market. If you take the top 10 companies on the Nairobi Stock Exchange, they are 80% of the NASI index, which is price weighted. So it does not fully track all the movements. All right. So for a market capitalization index, but for a price weighted index, it uses all the prices, but where you don't equiweight it, meaning you don't remove the impact of higher prices, then if one share has 4 shillings as its price and another at 20, the one at 20 will affect the index more. We tend to find the price weighted one on the Nairobi Stock Exchange, the NSE 20, tends to get the overall movement of the market, but misses out when certain large companies have a movement in price and is affected more by price movements of smaller companies. Thank you. That is the end of the presentation, and we can have questions.
Thank you very much, Steve.
Yes, thank you.
But we won't let you go. So you might have to hold on.
I'm online. Yes. Questions.
Fantastic.
Yes.
Absolutely. But before we have the question and answer, we have also, okay. We have also one more presentation. So I would ask you to mute just so that we actually can hear each other. So the next presentation is from Afrexim Bank by Miss Anne-Rose Negemu. As a passionate advocate for the Agenda AU 2063, I'm actually following and listening to what Afrexim Bank has been doing. So I'm just keen to see what they actually are doing in the area of trade, particularly in the interest of trade exchange. So I'm not going to be moderating this one. I'm just going to be amply writing. So Ms. Anne-Rose, let me hand it over to you to walk us through what Afrexim is actually doing on that space. If you could unmute yourself. Okay. Or let me ask. You have muted yourself, so if you could kindly unmute. The beauty of technology is it actually frees us when you're passionate about something. So it could be my passion doing this.
Hi, good morning. Sorry, finally done. And sorry for that short,
no worries.
Short technology. Good morning, everyone. I still believe we are in the morning. As introduced, my name is Anne-Rose Ngemu. I work for the Africa Imports and Export Bank based in Cairo. And I specifically look after commercialization and market solutions. So I'm seated within a department, within the Strategy and Innovations department, but specifically looking after commercialization and market solutions, largely digital solutions. So today I would like to speak about the Africa Trade Exchange, which is one of the market solutions that the bank, alongside ECA, have developed and launched in the market to support largely intra-African trade and, of course, extra-African trade. I would request that you allow me to share my screen. I'm not able to share on my set. Okay, let me do that so that I run you through the presentation, and then I can take questions and answers after. Let me know if you can see my screen.
If you could kindly put it on full screen, and you've got 15 minutes, although I would want to give you a full hour.
No. Can you see my screen now? Hello?
Can. Yes,
You
we
see my
can.
screen?
Yeah.
Okay. Yeah, okay.
Yes,
So,
yes, yes.
so the African Trade Exchange, we call it the ETX platform. And as I mentioned, it's a tool that has been developed to largely assist in unlocking trade within the African continent and out of Africa. So in terms of background, the Africa Trade Exchange was conceived between the Economic Commission for Africa, Afrexim Bank, and the SCFTS Secretariat. And it was largely conceived to assist in the implementation of the SCFTA. So the objective of the platform is to ensure that from an African context, we have a platform that offers centralized point where buyers and sellers, and when we talk of buyers and sellers, we are speaking about large buyers, large sellers, but even small buyers and small sellers aggregated to become big buyers and big suppliers come together to improve cross-border trade within the continent. And this is largely through ensuring that the goods that are placed on the platform are of quality and they are verified. They are verified goods from African suppliers. The platform, as I mentioned, is a B2B, meaning is a business to business and business to government. And it is one of the platforms that is envisaged to host the updated rules of origin and tariffs as per the SCFTA. And the key thing is to ensure that it opens up opportunities and creates a level playing ground for intra-African trade to kick off, and kick off in a large way, because as we know, currently we are at around between 16 to 17% compared to other continents that are way above 40%. So when I say kick off, I mean kick off in terms of raising that percentage from 17, 18 to where the rest of the world is. So in terms of how is the ETX positioned to achieve that? One is to ensure that it supplies or provides a forum where goods are hosted digitally, qualified products from verified suppliers are hosted digitally. Payments are enabled through, among other options, the African Pan-African Payment and Settlement System, PAPS. I'm not sure most of you know about PAPS, and those who may not know about it is a payments platform that will allows buyers seated in one African country to use their currency to buy, and the seller on the other African country settled in their currency. So if I'm buying from Kenya, I pay in Kenya shillings, and the supply in Egypt is settled in EGP. So that is what the Pan-African Payment and Settlement System is expected to achieve across the continent. But that is not to mean that ETX only supports PAPS, but is one of the major tools that ETX will of course leverage to ensure that payments are settled seamlessly. The other aspect of ETX that has been built into the platform is to ensure that we provide logistics so that when a buyer and seller are matched, verified, onboarded and matched on the platform, and they enter into a trade deal, and one of the needs arises on logistics where they may not have had their own logistics provider, then the platform itself connects you to a logistics provider within the same environment. The other thing that it also has provided is financing. The financing is direct from Afrexim Bank in form of trade instruments such as letters of credit and confirmation of letters of credit issued by our African banking partners, as well as bringing on board banking partners who are willing to look at the trade requests that are coming out of ETX and financing directly from the platform. So it's providing a complete ecosystem where you start by first meeting verified buyer, seller, having the discussion on the platform, of course, supported by dedicated account managers, and then accessing quality goods, then having your payments fully connected in the environment, logistics provided, and financing for those who may need financing to support the trade. It's a B2B, as I mentioned, and a B2G platform, allowing both businesses and governments to do the transaction. At the moment, we have over 153 products that are being listed on the platform. It is free to join. And as I mentioned, is unlike the typical business to business and business to government platform, ETX has been uniquely designed to ensure that it's not just a digital tool, but an ecosystem that supports the trade right from the verification, the execution, and account management to ensure that the buyer and seller have a seamless experience throughout the platform. From a status perspective, at the moment, we have over 1,300 buyers and sellers who have already been verified and onboarded onto the platform, 722 of those being suppliers and about 535 buyers across the continent. Key to note that the suppliers are both in the continent and outside of the continent. So the 722 are part of African suppliers and suppliers outside the continent. We have over 100 products. As I mentioned last, it was around 153. We are almost getting to the 200 mark. And then we have trade services provided through Afreximbank at the moment. And I will shortly be showing how we are bringing on board other trade services providers into the platform. As I mentioned, it's taking an ecosystem approach. And as we know, what ecosystems do is to look at who are the key partners to participate. So we look at the buyers, sellers, payment service providers, trade finance providers, large corporates, logistics companies, verification companies, and have all of them seamlessly connected to the platform, all aimed at ensuring that once a buyer and seller are within the platform, any service that they may need to have their trade facilitated from start to end is provided within the ecosystem. So how is this made possible? It has been made possible through a set of continental partners, ecosystem partners. Of course, with the lead developers being ourselves, Afreximbank, and the United Nations Economic Commissions for Africa, with the AU and SCFTA as strategic partners. And the other thing, the other key partner that has also been brought on board is to look at who in the continent can ably operate the platform, because as you know, we are a bank, so we may not have all the capabilities that are needed to run a business to business kind of platform, like the way Amazon is run. So we've brought an equivalent of Amazon, which is what we are calling a ways to curb ETX operator. So the company is called Ways to Curb. And what they do is they have experience in business to business and business to government operations of a platform. So they basically manage the platform and operate it on behalf of the lead developers, which is ourselves and the ECA. Now, in terms of the operations itself, I kept talking about having an ecosystem approach where traders or participants within the ecosystem will be facilitated from start to end. So ETX is sitting in the midst of other digital assets for the bank. Plus, it's also going to tap to other external digital assets that come into play and are facilitated through the larger Afreximbank digital ecosystem. So as I mentioned, we have PAPs. We have a platform called Mansa. I'm sure most of you have heard about Mansa, that enables counterparties to be verified and onboarded, so that when a trader is, when a Kenyan trader is dealing with a supply in Egypt, for instance, and they need to know whether the supply is legit, then Mansa provides a window where you can actually do the check yourself. It also connects, ETX also connects to a set of platforms that we call trade regulations and trade intelligence that enables you to scan through the continent and find where opportunities exist. And in addition to that, give you a clear check on what the rules and market conditions of the particular country that you may be interested in look like. So it gives you that information still within the ecosystem. So in addition to ensuring that you have the payments, you have the logistics, you have the financing, and you have the account management to do your trade within ETX, it also gives you a direct connectivity with the other digital assets that the bank has put in place, as I mentioned, like Mansa, for you to verify any KYC issues that you may have with a counterparty, and the trader regulation and trader intelligence for you to get to know what market conditions exist in the market that you're interested in and where the opportunities exist. The other interesting aspects that it brings together is the ability to pull in partners who are not part of the current ecosystem. And that is where I want to focus on in the current slide. So these partners are largely banks, insurance companies, logistics companies, who we are now pulling together to bring into the ecosystem to support buyers and sellers across the continent, because we note that we are not able to service all the demand that is even currently coming into the platform. So we are bringing in banks. Currently, we have these 4 that have already signed up, but the discussion is to now work with banks across the continent to bring them as part of the ecosystem in a service that we are calling ATG Connect services. So what the ATG Connect services will enable banks and logistics companies to do, if you're within the logistics provision services, is to have access to the opportunities that are being generated from ETX. And just to give context, currently we have RFQs, requests for quotations from ETX for buyers of over $600 million sitting on ETX. So for banks, is a large opportunity for you to actually look at buyers who are interested in financing, and for some reason have not been able to get that financing directly from Free-Exim Bank. Why would that be the case? Because in some cases, the buyers are not, they are corporate buyers, but they are not within the threshold of the bank, because as you know, we are a DFI and we have a threshold, a minimum threshold that needs to be met for a corporate or for an SME to borrow directly from us. And that's why we work with banks across the continent. The other reason we do that as a bank is because we do not want to kill the local banks. We want to enable the local banks to do business. So even where we can fund, we want to pass those opportunities to the local banks so that they can be able to do the funding directly. So this connectivity allows banks to come in, look at the opportunities, reach out to the buyer and seller. For those who are interested in financing, discuss the financing options, directly finance, or directly finance with Afri-Exim Bank offering confirmation of some of the trade instruments that may be issued. Like, for instance, for all our partners that we work with on LCs, we offer the LC confirmation lines for trades that are supporting ETX. The other thing that I mentioned is that there is dedicated trade account management. So what our operator Ways to Curb have done is, in addition to putting all the digital tools in place, they've also put a team within Ways to Curb of dedicated trade account managers who understand the trade value chain, right from verification all the way to fulfillment of the order. And so when a buyer and seller are matched and the trade starts, they allocate a dedicated trade account manager to support the journey of the buyer and the seller until the fulfillment is done. And then lastly, as I mentioned, is also people in or companies in logistics that are interested in accessing opportunities. We're also bringing those ones on board to ensure that once you're in ETX, then your entire chain is supported from verification all the way to fulfillment. In terms of what the next steps for those who are in the room and may be interested is, we are currently actually very out there looking for banks, logistics partners, and any other partner who is interested in participating to enlist on the platform as a service provider. Once that happens, then we do a bilateral and form a partnership where, one, you begin accessing the opportunities, and secondly, for banks, we know that you have clients who are buyers and suppliers. We discuss with you on how we can expose ETX, because by exposing ETX to them, we're also helping the bank to ensure that their clients grow. And then lastly, once that relationship between ourselves and the partner is done, Ways to Curb allocates you a dedicated account manager to ensure that any transactions that are done on ETX are well supported from beginning to end. And for those who are interested, those are our contacts. I'm available to take questions at the end of the session. Thank you.
Thank you very much. Miss Anne Rose, you made my life simple because I was about to tap on the mic and say time is out. We would be doing some few adjustments in the interest of time, just to let our moderator know. Mr. Joseph Atmensha would be chairing the next session. But in the interest of time, and because our team is always available, we ask that the questions that Mr. Joseph might have would be directed to Morris and Mr. Steve in the absence of Mr. Anthony. But I would leave the question and answer more to the team. And Mr. Joseph, you've promised a question and answer and an exam. So hopefully it would be in the afternoon, not today. So please help me in welcoming Mr. Joseph Atamesh.
Who asked you to come? I didn't even call you. Is that how we're going to be treated? Anyway. But it's great. It's great that you are here anyway. Good afternoon, everyone. I think is it afternoon yet? 15 more minutes. Good morning. We've come to the almost the end of the first morning session. And I think yesterday we were taken through by colleagues about the debt market, money market, all those asset-backed securities and all that. And today we are looking at the other side of equity market. But I think something that might be coming through your mind is, what is the difference between these two markets? I think it's important for us to understand that, right? So the question is that you have a company and you want to grow the company. You have two choices. You can go to the money market or issue a bond, which means you are going to borrow, right? You're going to ask people that you need money. So therefore, you have to write a bond or something. And then they will give you the money for you to grow. But you could take the risk and say, I'm not going to ask for money, right? You give me the money, but the money, instead of, I won't pay you back. In the equity market, I don't have any obligation to pay you back. The only thing I'm giving to you is my obligation to say that you also become an owner of the company. So it dilutes ownership. I think it's important for us to understand, because most friends that I know, that when they start up a company, they want to feel that they own it, and therefore they don't want anybody to come in. And so even when they don't have money to grow the company, they'll rather leave the company the way it is. But it's a win-win situation if you bring other partners in terms of equity. Right. So the two difference between yesterday and today, yesterday was talking about loans. Today is talking about ownership. And there are two markets that they've told you. There's the primary market, which you go through the IPOs and all of you to get the equity. I don't know whether Ethiopia would move to the secondary market. There is the secondary market where you can go in and buy shares, and then that allows for people to develop mutual funds and all that, which will let the company grow at the same time. And some people would also make money through that process. And then with that, when you go into the secondary market, then there are these guys who are going to come in. Those who want to hedge, a company maybe wants to hedge its portfolio, like go into the market precisely based on whatever it wants. It thinks of the future to hedge its bets. Or there are others who are very good, and these days with technology, might decide, I'm going to make arbitrage, profit from the difference in prices, right? But in arbitrage, in the long run, the price would equate if markets are efficient. But people want to make overnight, will make spot money on it. All this, I'm not, anything that helps us to grow wealth is good for the economy. Anything that helps us to grow wealth is good for the economy, because there'll be employment creation. There'll be other demands that we'll be able to do. So therefore, it helps us. So the other thing which I got from this morning and yesterday, and if you want to put it in a holistic or whatever you want to call it ecosystem, is that capital markets, be it whether the money side, money markets, treasury bills, asset-backed securities, or what have you, or the equity market, it's all geared towards helping us. If you look at the global, global stock markets, it used to be about 2.5 trillion in 1980. Today, it's between 93 to almost 100 trillion, which is a lot of growth for wealth, right? So see the wealth that the world's GDP globally is growing, and think of that for Ethiopia. Think of that for Ethiopia. Maybe not today. Today you might be jittery. Everybody's worried. Do we have the skill sets and all that? But 20 years from now, you'll be laughing all the way to the bank, right? So let's be optimistic. Let's be optimistic. And one thing which is important, that as we create this equity market or capital markets, there's need for transparency. That is key, because anybody in finance will tell you, for asset price discovery, you need transparency. You need transparency, and therefore news and all that. You want companies who want to raise money should be good in making their books open, because that's how people would have confidence to be able to invest in. So it's important. The other thing that I want to leave you with before I bring the panelists is basically also, and I'm happy when and the presentations were done today about East Africa, where members of the EAC, Uganda, Rwanda trade across countries. When Ethiopia, Mike, when you grow, open up so that I'll be old, but I could come and buy shares from Ghana in Ethiopian Airlines. That's my dream, right? So let's think about cross-listing because our markets are too small. For Africa to do well, the biggest is Johannesburg, the Alexandria, and maybe which else? I don't know which ones I can mention. But if, and maybe the one in BCL, the one in West Africa, which Lagos, it's not that big, my friend. we're talking about lots of money, you know. It's reasonable. It's reasonable. But I think if we can put, you know, when I personally believe that we should have an African stock market. That's my view. But I think countries tend to be jittery about that. But short of that, if we can't get the African stock market, at least we should open up so that there'll be cross-listing. Because what it does is that companies like Ethiopian Airlines can grow bigger, right? Or Kenya Airways, or Air Morocco, right? Or maybe even a small factory here in Ethiopia, you know, could benefit from others' holding shares from far away. They don't have to even come to Ethiopia. They just tell their broker, I need shares in Sheraton. And they buy. So I think, to me, the project that Ethiopia is embarking on is great for Ethiopia. But I think eventually it will be great for the continent if we allow others to come in. That's what I would say in terms of, let me just shut up and then get to what I was asked to do. Okay, so we have Morris here. Excellent presentation this morning. We have also Telone over there, and Solomon, you're also here. We're not going to discuss your pants, okay? No discussions on your pants, or whether trousers or whatever, you know. And Steve, are you still there? I can see you. You can hear us? We can hear you. Andros, are you there?
Yes, yes,
Andros,
I'm
are you there?
Yes,
okay,
yes.
So
Yes.
okay. Yes. So I'm told that I should ask questions quickly to Morris. What's the moderator? Okay. So Morris, let me start with you then. Thanks for your presentation, excellent presentation. What I want to ask you, you know, a stock market is supposed to bring buyers and sellers and all that. Could you, in terms of an advice for us, as Ethiopia is going through to set up, you have a rich experience, right? How do you think Ethiopia should go about getting the buyers and sellers? And also it's important that I think the presentation that you made, most of the sellers buyers are institutional, which are mainly the financial sector. But individuals want to make a little bit. So how can you attract individual investors? And how can Ethiopia build that clientele?
Thanks to the question. Of course, for a market to be up and running, the first principle is we need to have the securities outside there in which can create that demand and supply. Looking at Ethiopian market today, I think the easiest way to first have the primary market working out is to have those companies which perhaps today meet the set regulations to be listed. And in this case, I think the low-hanging fruit here is the financial sector, banks. Having gone around, did roadshows, I think a number of banks in this market are almost ready to be listed. I think that those banks who could be having shareholding list as high as around 170,000. The next component to have a market function is who are these participants who will be investing. And for the participants to be out there, you need either a pension industry, which can be regulated. And in the absence, the pension industry will create for you the institutional market or the institutional buyers. That can then be complemented by the retail investors. And I think looking at the retail investors, the best way to then access the market is through financial institutions. So if those three components are connected, then you'll be able to have, those will be willing to supply the securities, and also those will be taking part in buying these securities.
Thank you very much. Okay, I think in terms of the interest of time, since you've been patiently listening to all the presenters, I think the best is that I'll give you the opportunity to ask questions now. And if there's time, I'll come back with my own questions for the panelists. Anyone who wants to ask a question? Any? Why is, well, did you, either you, okay, go ahead.
Thank you very much. My name is Merit Fikranis. I'm from Pragma Investment. On Steve Machello's presentation, you were talking about that the asset management fees are going down and they're very significantly low in Kenya. I personally believe that Ethiopia's capital market journey, we could learn a lot from Kenya. I was hoping if you could delve into the reason why the fees are getting low, because you were saying that they're getting low significantly. If you could please expand on that. Thank you.
Thank you very much. Steve, could you hold your fire?
Okay.
And any other person? Any other person? Any other question? Yes, there's a lady over there.
Thank you. Thank you. So my question is, taking what Dr. Talahun said about the segment for SMEs, taking that concept, when it comes to Kenya, how much, when you think about who's actually the investor in the Kenyan Stock Exchange, how much of the market activity would you say is by these SMEs who, because ideally if you have a lot of SMEs, you'd hope that there's more economic impact. So do you find that there's increasingly or significant amount of SMEs or people in the lower economic bracket participating in these markets as investors?
Can we get one more question before, so I can, so your question was for who? For Solomon? Any of the panelists? Okay. Okay. Yeah, no. I think I'll come to you if we have any other person. Any other person? Okay, this gentleman.
Okay, good morning all. My name is Fantabil from Amhara Bank. My question may be for Dr. Talahun and Mr. Solomon. Thank you for that insightful presentation.
Go ahead. No, use the mic, please. Are you done with your question?
Okay, no, I didn't.
Oh, go ahead.
Okay, thank you for that insightful presentation. You make mention of on the regulatory part of the stock exchange members or those who will be listed on the stock exchange. You talk about the profitability, you talk about the legal matters like auditable or maybe working in the market for more than 2 years, 3 years. And when we see the Ethiopian market, the new institutions, especially in the financial institutions, the new financial institutions that came, have more shareholders. When it comes to count shares, we talk of about 350 to 500,000. Almost 50% of the share owners are from the new institutions. I'm just being scared. will it not affect these new incoming institutions to participate in the shareholding, because they may not be profitable in 2-3 years because they are just beginning, and they may not be having a good account statement or audited statements within these 2-3 years, and keeping these people outside or keeping them outside the market may affect the 350 or the 500,000, he said, because they have more shareholders.
Sir,
It is going to affect us.
Can you wrap up?
The other, thank you. The other speakers speak about the East African market. The East African market, if East Africans or East African companies are going to trade within East Africa, they are going to be treated as a local. I think it's my sister, she spoke about. She spoke about they were going to trade as a locals. Now, a kind of Euro bond is going to be introduced. Now, when Euro bond is introduced, and if the East African countries are trading, what currency are they going to use? And are they not going to affect us? Within East Africa now, presently, we are even integrating the financial institutions, even in the name of correspondence banks. There are these political risks and so many risks. Okay. How are we going to operate this in the East Africa, the stock market?
Thank you. Thank you very much for your questions. Stephen, can you come in?
Yes.
To respond to your, go on.
All right. So I'll answer the question about fees and why fees have been coming down in the asset management industry in Kenya. So fees have been coming down more on the pension and corporate side, not on the unit trust side. And the key reason why fees have been coming down is that new asset managers have been unable to differentiate themselves. So you come into the market, you want to get assets under management. So assume there's 1 billion out there in the market. Everyone is earning 1%. How do you get a share of that? You cannot say, you don't have the ability to say you're better than the next manager. So what do? You say, if the current managers are charging you 1% to run that mandate, we will charge you 0.8%, 80 pips. So give us the business because we are cheaper. So it's been an issue around. And then remember also, we don't have regulations on minimum fees that you can charge. So it's been more of market share, people looking for market share as new managers have come in, because we are over 20 asset managers in the market. So that's been the primary cause of the fees coming down.
Okay, Tilahun or Solomon?
I'll pick the question with regards to SMEs. I think there's no need to fear really SMEs. They're your next larger corporates in 5 to 10 years. So how does Nairobi Securities Exchange handle the SMEs? We have a platform in which SMEs can work with nominated advisors. The nominated advisors will guide them through what should they do about their financial reporting, what should they do about their corporate governance. And also we have got an alternative market segment whereby the requirement from a capital perspective is lower.
Solomon?
Okay, I will attempt to answer Fanta's question regarding being for the companies that are starting up being left out of the capital market ecosystem, participation in the capital market ecosystem. This has been a great concern to us when we draft the directive on public offer. We have had lengthy discussion about this, especially not only about companies that already exist, but also about companies that are under formation. So most probably our approach will be inclusive. So we're drafting the directive so that even companies which are under formation would be able to participate in the capital market ecosystem and raise capital through a public offering. So for companies which have already been, which are already in existence, I don't think it's going to be a worry for you guys. And we will, as you will be included in this process. So specific will be available when the directive is finalized and put for public consultation. So one thing I would like to say at this time is, you will not be excluded from participation in the capital market ecosystem. Thank you. If
Talon, do you have anything to add? Who would like to answer the last question about the euro bond or whatever he was talking about, and what currency are you going to would be used for trading? Who was you? I think it was referring to Angela. Yeah, I think you made the presentation. Anne Rose. Anne Rose? Is it for Anne Rose? Is your question for Anne Rose? Okay, Anne Rose. Okay, let me take advantage. Anne Rose.
Yes, I can hear. Yes, I can hear you.
Okay, so Anne Rose, maybe to answer this question, you know that at Exim Bank, you've been doing what is called PAPS, right? The payment systems, where individuals can use their own local currency to trade. Could you probably tell us a little bit about PAPS? Maybe that would help answer the questioner's question about how trading can be done and what currency can be used. So can you tell us a little bit more about PAPS, if you could?
Yes, I could. So as I mentioned in my presentation for ETX, what PAPS aims to do is to lift the burden of looking for hard currencies on the part of the trader. And so what it does is it allows you to transact in your currency, in your local currency, and settle on the other side in the currency of the counterparty that you're transacting with. So if I take an example of Kenya and Ethiopia, or Kenya and Cairo, Egypt, where I'm based, then it allows a trader to walk into their exchange, do all their transactions in Kenya shillings, and the settlement on this other side in Egypt is done in EGP. So the bid for settlement is between the commercial banks and the central bank. Currently, the way it sits is that the trader has to look for the currency and have it in the account before they transact. So it's trying to remove that burden of the traders looking for the hard currencies and having it on their accounts. I don't know if that summarizes what it is in a simple language.
And I understand it, but does it meet your question? Is that what you want? Or would you clarify? Okay,
Perhaps I can just add a point to the question that had been put through.
I think he wants to. Let's give it. Yeah, go ahead.
So, dependent on the transaction, specifically not talking about equity transactions, it really depends on how the transaction has been structured by the transaction advisor on where the conversion risk sits. So it could sit with the issuer, where, let me give an example. Yes. So like Umeme, when it was raising funds in Kenya, from the institutional investors, they raised it in shilling, and they take the responsibility to convert from the shilling, Kenya shilling, to the Uganda shilling. Such that that risk is not passed on to the investor. Because what happens is that when you pool these funds, it's easier to get a good exchange rate, from the financial sector. So it's all about how transactions are structured in such a way that they do not disadvantage the institution and retail investors.
Okay, can we take one or two questions so that we sum up? I think we almost there's a hand over there at the back.
Oh, hello. My name is Munir. I'm a journalist from Addis Fortune News.
Could you speak up, please?
My name is Munir. I'm a journalist from a local newspaper. My question is to any of the Kenyans. How have Kenyan markets reacted to systemic shocks like the COVID pandemic or other black swan events that bring about credit crunches or sudden shocks to markets? Has the central bank actively participated? What kind of tools are in place in Kenyan markets to tackle this kind of unprecedented shocks to the market?
Okay, one more question from a woman. One more question from a woman. A woman, so that you don't accuse us. Yes.
Thank you. My question is for Ato Solomon.
For who?
Solomon.
Okay, could you speak up a little bit?
Okay. My question is around assurances to the investor. I think audited reports are a big source of assurance. And what kind of framework or support can the legislation provide in ensuring that the audits are being performed in sufficiency for the local auditors within the country?
So we have two questions. One for the Kenyans who are here, Stephen or Morris. How has the market been able to handle the pandemic, the shocks of pandemic, and or shocks of the war in Ukraine? So, and then the Solomon, the question is about, sorry? Okay, it was in my mind, but I just lost it. Yes, transparency in terms of reports, annual reports of insurance reports. You heard the question, right? Yeah. Okay, so let's leave it at that. Okay. Okay, so Steve, do you want to take it, and Morris, to answer the question about how you handle shocks?
Yes.
Go ahead, Steve.
All right, thank you. So I'll talk about the question in two ways. First, the market and what has been the policy response. So markets, in terms of internal markets and even internal events, we've tend to find the market is lagged. The big one for Kenya over the last 15 years has been post-election violence, where we almost had a civil war. So when that happened, the market froze. You didn't see any market activities, prices didn't drop significantly. But 6 months, 8 months later, when now the events filtered into the economy, the market dropped. So the market tends to lag local events. When extremely nasty events happen, it doesn't take a hit immediately, it takes a few months. Now, global events like COVID, interest rate rises, the market tends to react more actively. But that's also because 50% of the market is foreigners. So if you look at the Nairobi Stock Exchange, it's been sliding for the past 1 year. Why? Foreigners have been exiting. Because interest rates in the West, especially US, have gone from less than 1% to 5%. So opportunity cost of holding money. So that's how the markets have reacted. In terms of policy response, the regulators have been very active, especially around, if you look at around issues of bank failures, if you look at COVID, the central bank intervened by getting the banking sector to effectively give most people who had borrowed money and could prove that COVID had affected them a repayment holiday and restructure the loans. So quite responsive in terms of the regulator and market-based interventions. So rather than lower the interest rate first, actually talk to the banking sector, the finance sector, and find out who is affected and how can they be accommodated.
Okay, Solomon, quick one.
Okay, as I said earlier, disclosure is critical for having a proper functioning capital market. And one of the basic disclosure that we are going to require either on initial offering or ongoing basis is the audited financial. Unfortunately, requiring something and getting in a product or a result that is a quality result is something else. And the proclamation, when we talk about the capital market service providers, it did not give us the authority to licensed auditors. So auditors are being licensed by ABE. It's not, they are the licensing of auditors that are going to be acting within the capital market ecosystem is not within our jurisdiction, but there is another mechanism where we try to ascertain and make sure whatever audited financial audit is done properly and it has some quality, which is through the process of recognizing auditors that are going to be participating in the capital market authority ecosystem. So if an auditor, we will have a list of auditors and we will be requiring whatever companies that are going to submit their auditors financial to use those listed auditors so that we can ascertain that whatever final product that is going to come out of that audit process will have the necessary quality that's necessary for it follows the proper auditing procedure.
Thank you very much. I think time is up, but these are the takeaways that I get quickly. 1 minute. The first thing is that the financial institutions are important for well-functioning capital markets, particularly the central bank again has to play a role. It's important that as Ethiopia begins this journey of building a stock market, it should draw experiences from either the neighbors or from other capital markets in Africa. 3, don't worry about investors about the question of fees. It might start high, but eventually with competition, the fees would come down. 4, no need for SMEs who want to be part of this ecosystem to fear. You shouldn't fear because it's important to have the capital markets to grow your company. It is important if you want to grow, except if you want to remain where you are. The capital markets, as was said by the presenter number 5, is that it has to be inclusive if it has to work. It has not to exclude other players. Every player in the beginning, maybe it will start small, but eventually it should be more inclusive. Number 6, it is important that as the market grows in Ethiopia and as markets grows around Africa, we should begin to think of having an African stock market, how all these markets can come in so that we can grow more through that. The other thing which I have a takeaway is in terms of global shocks or shocks in general, be mindful. If you have more capital, always run to where it can get more return. So in Africa, when the Federal Reserve starts increasing interest rates, foreign companies think they would make more money, so they head for the exit. So we have to be mindful of all that as you set up your capital market. Be mindful that these shocks can affect it. And stocks are not for the faint-hearted. It's for the long haul. Don't panic when the stocks begin to fall. Stay in for the long haul, and you do well. What has also come out here is that it's important that we have full disclosure of books. So therefore, audited reports should be made available so that those who are going to go in would have access to those reports. And the last thing that we also talked about is that there is also a mechanism for trading, which is known as the PAPS, which is set up by the Afro-Exim Bank. It doesn't require you to use your foreign currency. You can do all your transaction here in Ethiopia in birr, but make sure that you have the money in that bank account. And then the counterparty would also receive it in the local currency. But in all this, don't forget, don't be fooled. The exchange rate still plays a role. Okay, the exchange rate still plays a role between countries in terms to make this domestic currency trading happen. So on that note, I thank you very much. But before then, let's thank Stephen in Kenya, Anne Rose. I think she disappeared. Is she still there? We thank her in Cairo, and then Morris, Solomon, and Talaun here in Addis. Thank you so much for your presentations and for your work. So.
Have a nice day.
Thank you. Thank you.
Bye. Bye. Bye, Steve. Bye. Bye. Anne Rose.
Bye. Bye. Thank you.
So thank Joseph for us as well. He needs a warm hand. So we're now at 12:20, and the team is actually standing by to ensure that you have your coupons. For those of you who are new, the lunch is going to be downstairs at the terrace. For the rest of you, you already know the way to that venue. But we'll be back in an hour. That would be 1:20. Disregard what it says on the program. It is 1:20. Thank you. Three-quarters of the people back, right? People are turning around to check who is missing. That's a good sign. Hope you enjoy your lunch. I most certainly did, thanks to Uncle. I think in the interest of time, we would be kickstarting the session. And the graveyard shift is being given to the most energized, eloquent, and going to entertain you. I'm going to put a lot of pressure on Miss Elizabeth Getachew, legal advisor for Ethiopian Capital Markets Authority. So please help me in welcoming her to the stage. My pleasure.
Good afternoon, everyone. Thank you for having me. Today, as already Yodit told you, my name is Elizabeth Getachew. I am from Ethiopian Capital Market Authority. So I was going to say Commercial Bank of Ethiopia. It's just, I've been there for a long time before ECMA. Today, I'll be shortly discussing with you about building best practice regulatory ecosystem for a vibrant capital market development. We'll be seeing key factors for the capital market development. These are clear rules and regulations, investor protection and education, efficient market structure, fair competition or enabling environment, effective enforcement, international best practice, and collaborating with industry participants. We will try to briefly discuss each of the key factors for best practice regulatory ecosystem of the capital market development. The government has laid the basis by enacting the Capital Market Proclamation in July 13, 2021. And then after ECMA is established by Article 3(1) of the proclamation, the Ethiopian Capital Market Authority is an essential and a key institution. And the PM has also appointed the board members and the Director General of ECMA. I hope almost all of you know about this. It's not a new issue. The key objectives of the authority are protection of investors, ensuring the existence of an efficient market, and reduction of systemic risk. These three principles are major principles that you can see in almost all international developed markets. But the fourth one, create, promote, and facilitate a robust capital market environment fit for long-term investment, are mostly found in a developing market like Ethiopia. powers and the duties of the authority, that's mandates. Powers and duties of the authority are tremendous in the proclamation, but I have tried to sort out measures. Those are granting license to any person, or legal person or artificial person, to operate as a securities exchange, derivative exchange, securities depository and clearing company, capital market service providers, OTC trading facilities. These OTC trading, what we call OTC trading facilities, are already practiced in Ethiopia. That's over the counter trading facilities. And the authority also issues directives, procedures, regulations, and it regulates and oversees the issuers and subsequent trading, supervise the listing and the delisting of securities. Then we will see about we will discuss about the directives. ECMA up to now has drafted 10 directives and 2 regulations. Among the 10 directives, 3 of them have gone approval by the ECMA board and public consultations, and many more are going to come out. The 3 directives that are already approved by the ECMA are licensing and supervision of capital market service providers, licensing of securities exchange and trading platform. That is, the ECMA is going to hopefully in a few months will give the license for the ESX, and recognition of self-regulatory organizations. These are the 3 directives that already passed the necessary formalities. And the 2 regulations are the employment regulation and the compensation fund. The employment administration regulation of the ECMA has also been approved by the board and currently being reviewed by the Council of Ministers. The second key factor that we should consider as a regulatory organ is efficient market structure, providing an efficient, transparent, and secure trading infrastructure for all market participants, enabling them to buy and sell securities seamlessly. These are the, I have laid out 3 market structures. The Ethiopian Securities Exchange in the market, that it needs to be placed in, it needs to be placed, and this is a major market structure, adopting central securities depository and the CSD. When we talk about the CSD, we think of dematerialization of securities. In order to have seamless transactions, the securities needs to be in electronic form, and establishing a securities depository and clearing company, settlement and clearing has to be seamlessly structured. The other key factor, investor protection and education. Protection of investors and fraudulent and illegal activities is basic. To protect the investors, the authority is drafting directives and putting in place procedures for registration of any participant of the capital market should undergo under the supervision licensing of the authority. The other is capital development. I'm sorry, capacity development, I mean. Potential listing and companies and service providers needs to be developed. They need to take the necessary training and education and the license. The capital market is doing a lot of works in building the capacity. Communication and investor education is another way of protecting the investor and education. The next factor that I would like to address with you is enabling environment. We need to have an enabling environment for a fair competition, but the ECMA is working with the tax incentives, regulation of institutional investors, and macro financial policy. When the tax incentives should be enabling and critical conditions, exemption of excessive tax levied on capital markets should be reformed. So the ECMA is taking major steps and communicating with the respective organs for reform tax policies and registration legislative reforms. And macro financial policy, ECMA is working in collaboration with the other respective organs to have reforms on such macroeconomic financial policies. The other effective enforcement mechanism is that whenever there is an illegal activity, ECMA will have the necessary measures, and for that, ECMA is being ready for market surveillances, dispute settlement mechanisms, capital market tribunals, and conductive administrative investigations with the respective investigating bodies. The capital market tribunal will be established, and dispute settlement mechanisms directive will be enacted. And the 6 and 7 are international best practices in collaborations with industry participants. The ISCO principle and the best practice of international organizations will be considered for building the best practice economic ecosystem of the capital market development. In collaboration with industry participants, those are the the capital market participants and investors, intermediaries, and respective bodies of the country. Thank you very much for having me.
I think Elizabeth made it very short so that she doesn't have to bear the burden of keeping you awake without coffee and other refreshments. But I do want to give a warm hand to Elizabeth. First, for being punctual and saving 2 minutes, which then goes to Dr. Tilahun in the next session, who's going to give me back another 5 minutes. So please help me in welcoming back again Dr. Tilahun to the stage.
Less slides today. Thank you again. I guess, where is Teddy? Together with Dr. Tedros, we're trying to achieve 2 things. You might as well just come here, and then we'll keep them entertained. He's after me, right? So what are we trying to do is perhaps maybe we should have done this early in the morning or yesterday morning, but it's to try to set an objective and KPI to whatever we're doing today. And which is because we keep telling ourselves sometimes, and we kind of may live in a bubble, that the capital markets environment or any subject matter that we're dealing with is very important just for us and for the sake of service providers, for the sake of the exchange or the authority. But we need to know why we're doing what we're doing and what we're about to do, right? So here is a really rough figure, which Dr. Tedros is not going to agree with, but because I'm not an economist and I don't care, I'll tell you Ethiopia needs about 20 trillion birr in the next 10 years to service all our government objectives, public objectives. This year we have a budget of about 800 billion something, 20%, 30% deficit. Next year is going to be more. As more and more public projects are going to be planned because of us, government's going to keep needing more and more money. We're less likely to be able to borrow money from abroad than we used to. And our ability to raise funding and finance from the domestic sources have been, to some extent to date, limited towards the two pension funds that we have today. And only recently, you heard yesterday, when Nishat talking about when the T-bill market was liberalized, and you were involved as well, about 2-3 years. Since then, the diversity has slightly improved, and because we're among colleagues from the financial sector, you know better. Today it's almost 50-50. So out of our $50 billion debt, half is domestic, and from that half of it goes to the pension funds and half to the banking sector. And we know 90% of that has been entirely T-bill short-term instruments. So we need to expand the pool of resources, products, and also the participants in this market if we want to keep, our sovereignty and sanity, perhaps sometimes. So in that sense, then the role of the exchange, the capital markets authority, issuers, investors is trying to make a dent in terms of contribution towards that gap. How can we raise $1 trillion birr in the next 10 years to actually make a small impact than we have today in terms of the diversity of the instruments and products, et cetera, et cetera. So when a bank is issuing a bond or a government is trying to issue a bond or a treasury bill, we have to think of perhaps a reason why we're doing this. Our role as an intermediary, and perhaps the reason why we're being given these incentives, that arbitrage and the service fees that we were talking about this morning, is with the aim and objective of maximizing the role of capital markets to this gap. It's the same thing on the equity side. Another 20 trillion needed in the next 10 years. Where do I get these numbers from? It's from the, probably, I don't know, page 120 something of the 10-year perspective plan. Teddy will tell you whether or not this is realizable, where are we going to bring it from, et cetera, et cetera. We're trying to do a joint market sizing activity, which is leading. And I always said, are there macroeconomists in the room before I insult you? He's only, there is one? Okay, good. Then I will not say what I had in mind. So then the same thing for the equity side. We have about 20 trillion birr need. You would assume 99% of that would be financed through the usual methods, right? Self-finance, ECOB, our banks, et cetera, et cetera. The role of capital markets to date has been very limited. In fact, limited to the financial sector. What's the asset of the banking industry today? About 230 billion birr, right? And this is a 30-year history since 1994. If we want to raise $1 trillion birr in this manner, it's going to take us, I said I'm not an economist, 120 years. So we will need to perhaps ramp up our efforts, and that's why the Capital Markets Authority is needed, right? So to date, we've been limited and concentrated around financial sector. We need the non-financial sector to come in. That's why you have EIH trying to also bring SOEs into the market so that they don't necessarily absorb resources from the private sector and perhaps participate in the capital markets, trying to raise equity, but also debt through marketable instruments. In that sense, then what can we do to maximize our effort in terms of making a dent of a contribution into this gap? So all in all to say, we as service providers, as intermediaries, are a means towards that end. So from the authority side, the number of issuers that come into the market, you heard Solomon this morning talking about balancing, right? The authority will not be a satisfied authority if no one shows up to the market, isn't it? If their regulatory instruments are so strict that they would make it impossible for issuers to come to the market, then there is no point having the capital markets regime. Our obligation, perhaps to our taxpayers, is to help issuers come to the market, abide by certain corporate governance standards, financial reporting standards, be able to absorb someone else's money, just imagine a pension fund's money, then ultimately make a contribution towards that finance gap that we have, we're trying to meet. Same thing for service providers. So when tomorrow, the day after tomorrow, we'll be talking about fees. I'm surprised it came up this morning as well, but down the line, the capital markets industry would be accused of being, what do you call, self-interested, and because of the cost of coming to the market. And you'll hear, tomorrow as a financial advisor, you'll go and say, look, you need to pay me this amount of money, this amount of cash for my service, because you say this is a very expensive service I'm providing. There's no point being a service provider if we're not helping the market and the ecosystem grow. And if we're only interested in our fees, then we'd kill the market before it even starts. So that's all in all to say, our role as a service provider, issuer, and investor is what you call a stepping stone towards a certain objective. And I think that's perhaps a national objective. Now, whatever we're doing, I'm just becoming a moderator, Judith, if you allow me. Are we talking something sensible? What I was going to joke about was exactly that. There are few macroeconomists that I consider to be sensible, at least understand Ethiopia beyond numbers. And Teddy is exactly that kind of person. And it's a great pleasure to have you in this forum. Thank you. Allow me to step down if you want to continue. If you have a presentation,
Yeah, I do.
Go ahead. Thank you.
Thanks. Thank you, Tele, and thank you for those of you who have managed to survive to this last part of the presentation. Yes. Maybe full screen. Okay, thank you everyone. My name is Theodros. I'm a macroeconomist. Unfortunately, as Tele said, I'm not a finance person. But I think, taking in all of the really nice, hopeful, wonderful things that we've heard yesterday and today, I just wanted to bring us back to the current reality of the Ethiopian macroeconomy and highlight some of the key issues, challenges, or reform issues that we are, and then I'll come back to some of the really important key indicators that would signal how much funds will come into the market and what would be required to do that, and where does Ethiopia compare when it comes to really savings in general. So let me start with we've been discussing a lot about markets, prices, Nagades and Gabaya and everything. I wish Eva was there. But for the capital market to exist, thrive, and move on, it would require that other markets function as well. So I will talk a little bit about the functioning of other markets and how they're faring, what's going on at the moment, and how we're going to. So I would identify that first of all, we need to have because it is an important variable. We need to have stable commodity prices. So we need to have inflation at a reasonable rate for markets to function, and we need to have money and financial prices, interest rates, which are also related to the commodity prices, to be to be stable. And we need institutions. We need various mechanisms for that, and we also have foreign prices because we expect that we will also be attracting foreign savings. So we'll be talking about gross national saving as opposed to gross domestic saving. So because we'll be attracting, and I was surprised to hear that in Kenya about 50% of the funds are foreign. Of course, that has its own pros and cons. So all of these hinge on the stability of the macroeconomy. And I'm going to have a few slides talking about the Ethiopian macroeconomy, what has been going on, what are the implications for capital markets, and then I will come to the savings part. So I think this is something that you all know. I think most of you live in Ethiopia. We've been experiencing rapid economic growth, but it has been slowing. But even at the current level, it's considered to be one of the top in sub-Saharan Africa. And this has been largely investment-led, public investment-led. So it's not been, the private sector has not been driving growth, which is why we need the public sector to actively participate when the capital market also starts, because there are, a lot of resources are still locked within the public sector. When you look at sectors, construction and trade have been leading. This is their contribution to growth. So construction has been contributing to 29% of growth in recent years, while trade has been contributing to 17.3%. And you will see that the financial sector, commercial banks also focus on lending towards these sectors. And I'll come why this has an implication for future capital market investment. The share of agriculture, this is a productive sector. We want to make sure that these productive sectors like agriculture, manufacturing, get to benefit from investments in the capital market. The share of agriculture has been declining. The last fiscal year, it was 38.8% of GDP, while it still hosts 70% of the labor force. So most of our population is rural. So very valid questions on whether the rural population will be able to invest in the capital market. So we've been facing macro imbalances, high inflation, about 30% last month, came down from 33%. So I think most countries are experiencing high inflation, no doubt. We have a high external debt. Our debt, the value is not that big, as in compared to our GDP, compared to our income, but our ability to service that debt is strained. We have severe forex shortages. I don't want to say, because this is an audience with mostly banks, and I think everybody knows this issue. But I'll come back to some of the drivers later on. Financial repression and fiscal imprudence has been a big issue for us, and this has been worsened by the shocks over the past 2-3 years. So although we've been engaged in reforms to try and solve these issues, I think a number of them have. I think most reforms, most macro reforms have seen reversals in policy direction rather than progress, except perhaps the capital market initiative. I think should all be proud that the one reform that was launched with proclamations, with moving forward non-stop, is the capital markets, and I'm really happy that it has reached this stage. But that has worsened. So let's look at inflation. I think some of the biggest episodes in inflation, just to put in perspective, we faced in the late 2000s, early 2010s, where inflation reached above 50%. But we managed to control that. So we know quite a bit about inflation in Ethiopia. I think it's been part of our, and for economists, I think it's the one thing that we have studied time and again continuously until recently. So you can see that up until 2016, we managed to stabilize inflation, but starting 2017, and so inflation for us is not an issue for just the past year. We've been experiencing it for the past 5 or 6 years, perhaps. You can see that the red one is food inflation, which usually drives, with the exception of these past few months, where non-food prices are leading. So it's about 30–40% inflation. It's going to be very hard to attract, to encourage people to save when you have a 30% inflation, unless you pay them above 30% interest rate. And if you're talking about interbank rates at 7, 8, 9%, and we're playing marginally with interest rates, when you have such big imbalances, it's going to be very difficult to discuss all of those things. So you have to be a little bit sober about what's going on. So I think there's quite a bit of evidence, mostly macroeconomic studies, but because the food market has been driving inflation, we have also delved a little bit deeper into what drives inflation. So at the macro levels, we know that yield variability, international price arbitrage in food inflation are key drivers, particularly for food inflation. Core inflation, what we call non-food part of the inflation, is anchored by money. Money is an important driver there. So the more money we print, that's a big problem. Of course, rainfall variability for food inflation is important. We know that exchange rate drives inflation. But I just want to mention that most people don't know that there are asymmetries in effects as well. What we describe as asymmetries is that when we increase money supply, we know that inflation increases, right? But when we decrease money supply by that same amount, inflation doesn't come down by that same amount. So once you make the mistake of injecting money into the system, even if you remove that money, even if you're prudent afterwards, then that it will not have the same effect of bringing inflation down. So there are asymmetries because of what we call expectations. And this is something that most people know. Once people set expectations that prices will increase, they will be accepting higher prices, even if conditions are that low prices should come down. So that's one thing. The other thing we did is that there is usually blame on brokers. Brokers are the culprits. We want to blame them, but that's not the case. We take a deeper look at the food markets that we have, and one important structural thing that we've found out is that marketable surplus is between 17 to 20% for food items in Ethiopia. What we call by marketable surplus is that the farmers will produce food, but they consume between 60 and 70% of the food themselves. Imagine that as a market. You imagine consuming about 70% of your produce and only putting out like 17 to 20%. So with increasing production, increasing productivity, we expected that more will come to the market. But looking at the statistic, we see that statistic has not changed. It's between 17 to 20% still. But urbanization has increased, population has grown. So it's going to be a structural problem of higher sticking prices because of this issue. We also find that because of perhaps conflict and other issues, markets are increasingly, they were being connected. Interconnection has been increasing, but over the past 5–6 years, that interconnection is breaking down. And prices are now diverging from each other. If you look at regions in Ethiopia, different regional prices are diverging from each other instead of really converging. We expect that with increasing information, logistics improvements, everything, we expect prices to converge, but prices are diverging. So we took a look at particularly political events at zonal level in Ethiopia and started analyzing what happens to food prices there. We find that in Amara and Oromia regions, this was before the Tigray conflict, in Amara and Oromia, where there are conflicts in certain zones, particularly in food producing zones, prices in those zones during that conflict come down in the zones, whereas prices in central markets increase for those particular commodities. So take if it's coming from the Oromia region, in that particular zone, if there is a political event, prices for TEF will come down in that zone, whereas prices in Addis will come up, signaling that supply disruptions, is causing. So supply disruptions have been an important driver in food price inflation as well. So these are, the key, sort of the key drivers of inflation as we know today. I think Some of them are structural, but money is something that we can control. We can address that. And that's what we need to do. And I think there is a recognition from what I realized from yesterday's the Prime Minister's speech is that money supply, holding off on money supply is something that they plan to do over the coming year. Another important variable is exchange rate, and I want to talk about what are the drivers of, forex shortages and balance of payments issues. We have high current account deficit that has been there forever. We know that we are not able to export as much as we would import. We have high parallel market, parallel official premium, particularly in the past year. It has been increasing to reach about 100%, currently. So this is a binding constraint. But I mean, what has been driving? So this is, you can see the premium and the parallel markets move, and you see an inflection point. First, it was moving in a very low pace, growing in at a very low pace. Thanks. You see at growing at a low pace, but then reforms kick in, and you see a bit of speeding up, moving in line with the parallel market to a certain extent. And then about February 2022, you see a reversal in policy where that speeding up of exchange rate is now dumped down, whereas the parallel market rate just goes up. So it seems as if the parallel market did not care what the government was doing. The irony. So part of the reforms that were anticipated along with this capital market establishment was the speeding up of the exchange rate to narrow the gap between the parallel market, and then building up of reserves, moving towards a market-based foreign exchange system, promoting exports, remittances, FDI. All of these were envisaged, but very little has been practically done to really correct problems in the foreign exchange market. So premiums still persist, forex shortages still persist, and particularly I want to talk about the shocks. The COVID and the conflict particularly severely hit the balance of payments in Ethiopia. COVID really affected our exports and remittances, whereas the conflict affected our capital account, ODA, FDI. When these sources start to dry up, and because government needs foreign exchange for necessities, it imposes a very crushing forex surrender regime, which essentially kind of rolls back some of the intended reforms that were anticipated initially. So you see sort of we are increasingly reaching an unsustainable stage where most transactions, you are bankers, you should know, some of it passes through your systems. We know most transactions are moving out of the official system and into the parallel market, right? So that is unsustainable, and we don't have the reserves to back our 54, 55 birr per dollar exchange rate. Our reserves are less than 1 month of import coverage. So these are creating more of an unsustainable balance of payments situation. You see how in recent years foreign direct investments, ODA, and official transfers have been declining in the past year. So I think if your sources are not there, if your sources of foreign exchange are not there, but your demand still persists, and if you have an expansionary monetary policy as we have, and I'll come to that, then it's no surprise that your demand for foreign exchange would definitely outweigh the supply of foreign exchange. The third, important aspect that determines, the stable interest rates, if you will, is the issues of financial repression. So, what used to happen is that the government wanted to control resources for it to be able to get enough to spend in development activities. So it engaged in financial repression, and this you know very well. First is by channeling resources from the private sector to the public sector. The biggest tool was the state-owned commercial bank, CBE. It mobilizes 60% of all financial deposits, and then the channels more than 80% of it to the state-owned enterprises. And this means that about 50% of the financial deposits are channeled through SOEs, which is why the private sector is hungry, always hungry for resources, which means that it's not going to be able to have excess resources to spare to invest in any other activity, which would be important to address if you want if we want people to start investing in capital markets. I think these are very well known. I think there were reforms to try and address this, but I think there were also reversals in the past year with the start of DBE bonds, compulsory DBE bonds, and treasury bonds. These are compulsory things that I think are affecting your liquidities at the moment. Of course, then capital market would be, as a reform, the establishment of capital market came from this perspective initially. It was not because we wanted a beautiful equity market, a beautiful debt market, or whatever. It was not. It came from the realization that we've been crowding out the private sector enough. We need a fair platform, a fair place for the public sector to engage. And as Talon said, we need the capital market to let everyone play fairly. And if the government wants resources, it should not be engaging in getting cheap or engineering mechanisms to get cheap resources outside of the system, while the private sector is suffocating. So it was one of the ways where a fair source of long-term financing was envisaged. But with the reversals, I think it's important for the government to reckon with some of these other policies that are not aligning incentives to make sure that we get the necessary amount of saving to invest in the capital market. So if you are not depressed yet, I can have more slides. No, but on a positive note, I think loans and advances to the private sector doubled in 2 years. Credit to the private sector by the government commercial banks also increased significantly because of the reforms, which is really nice. Treasury bills, because it was market-based, was able to raise a lot from the banks themselves. In the previous times, they were not willing to do that. So it shows that if you align in incentives, if you allow the markets to work, people will engage. And the whole system works. People have that motivation to help themselves by engaging in a fair market space. So that's an important thing. So you can see that trends in private sector credit has outpaced the credit to SOEs, state-owned enterprises. So with just a few years of reforms, if we can achieve this, then we need to really capitalize on continuing the reforms to achieve better results in building market. So let me come to the main part and try to describe. So anyways, we've been talking about who's going to issue, who's going to buy, who's going to invest. So let's look at the numbers, right? So we expect that currently our system of national accounts suggests that our domestic saving is about 20% of GDP nominally, whereas our investment is about 39%. So we are really investing money that we don't have, which means we expect that if this thing continues, the capital market would have a lot of issuers, but perhaps relatively low, small number of buyers or a small volume of purchases. So, but we see that gross domestic saving has been increasing, but one caveat is that because of shocks, because of macro instability over the past few years, both investment and saving have been declining as a share of GDP. In level terms, they've been increasing, but as a proportion of GDP, they've been declining. So the red one is consumption, and these are saving and investment. The lower one is saving, the higher one is investment. This is as a share of GDP. They've been declining, and I mean, we shouldn't be as such that surprised to see this this decline if we are in a difficult situation. Now we need to reckon with what's happening with CBE. I think there have been a lot of improvements, and we need to relieve that bank because it is a commercial bank. It is designed to do commercial banking, not investment banking for long-term public projects, because let's face it, it mobilizes short-term deposits, and that term mismatch puts it in a very risky situation where it's not going to be able to finance the loans, especially when we face shocks like what we've been facing, and people's deposits started to decline. That it could lead to collapse of the bank in such a, so the need to fair allocation of resources comes to the fore, really. So what do we need to do? Of course, we are institutionalizing long-term financing, not just long-term, but we saw yesterday that even short-term, very short-term kind of investments can be done. Again, I will emphasize that for us, the priority should be a fair balancing playing field for the public sector and private sectors, because other countries, maybe it's a regulatory priority to make sure that actors play fair or whatever. But for us, it's the public versus private conundrum. Of course, we need to unlock idle capital. Even we don't have sufficient information about people who we are lending. As banks, we know that. That's why we have high collateral requirements, which locks up the value of the assets that we are collateralizing, which means that the country is not benefiting from the capital that it has, the saving that it has. Of course, investment inclusion is a very big role for capital markets to play, because there are millions of people with perhaps 5,000, 10,000, 100,000 birr who want to invest in something because they don't want to just keep that money because inflation is very high, but they don't have anywhere to put it, because they would have to wait until it reaches a point where it will buy a vehicle or a real estate or whatever, but other forms of investments are not available. So it's capital markets very key in mobilizing this. I just wanted to just show you the movement in real interest rate. Of course, this is driven by inflation. It looks like an inverted inflation graph that we saw earlier, right? Because interest rates are fixed, they're not variable. We want them to be responsive to different shocks in the market. We want them to respond to demands versus supply. That's not happening. We need that movement, and we presented a study to the National Bank on that. We need interest rates are just fixed, but now we are in negative 20% territory for interest rates, and how can we sort of move from that? Over the past 2-3 years, I think a lot more resources are being channeled to the public sector, reversing the reforms that we discussed about. This is claims on the overall claims on the banking sector, and you see that claims on government has been increasing. If you look at the last, this is because the government has been taking loans, direct advances from the central bank, which is very inflationary, and inflation is not a surprise in this case. Over the past year, we see that about 200 billion birr worth of direct advances channeled from the government. Of course, we've been in conflict, maybe understandable, but this will not fly if we wanted to move away. Of course, we need to address all of this. We need to remove financial repression. We need to clamp down on our money supply and start controlling inflation. We need to have functioning Forex and money and goods markets. And we need to continue building institutions to do that. I think I will answer any more questions if they come up. And sorry for taking too much of your time. Thank you.
I don't think he took much time, did he? So, yeah, because I never thought economics would be this interesting. But I don't know what Dr. Tilahun was saying, but I need to thank Dr. Tedros, because if this is macroeconomy, I'm joining. I'm coming to your team. Although you left us with a lot of numbers, with a lot of numbers, I think the message is clear. You're putting a lot of weight as well in the need for the market, for the capital market. And I don't think we have the ECMA and the exchange here. So all of this on one institution is a hard game, isn't it? But I think it does play a key role. That being said, I'm not going to spoil any more, okay? Because we have a Q&A session and I see people have been writing a lot. Dr. Tedros, please expect a lot of questions, including the moderator who's gonna come with a question to you. Coffee and tea is ready, but so as to continue the momentum and jump straight into the Q&A, I assume I'll check the program. You need to be back in 10 minutes. People are looking at me, 10. And you're gonna hear the clinking noise, like a lot. So please come back in 10. You can grab your tea, your coffee, and come in as well. Okay, thank you. Okay. Mary, can you hear us?
Yes, I can hear you. Can you hear me?
Yes, loud and clear. So let's just wait for the people to come in. They are on coffee break. I wish we could invite you, but I'll introduce you and hand over the session. You've got 20, 30 minutes. And you can share the slides as well on your side.
Okay, thank you.
Okay. I need to learn how to put that on the background. I like how you're presenting. It's technology thing, Mary.
Yes. I have to brand my employer. Yeah.
I understood clearly. The message is loud. Okay, let's just give them 2 minutes and we start.
Please allow me to share.
Yes, I think they have already allowed you to share. So once we're on, you can start projecting your screen.
Thank you.
I tell you, I'm clinging. You know? Should I do this or the clinging? So apparently, bankers are only punctual in their own bank. Okay? And the only one who has proved to be punctual is Ethiopian Airlines, Ato Meseret. Now I understand why the airlines is perfect. Okay? The rest of the bankers, we need to put interest on time, right? That way you know the pain. But thank you for coming back. And because Mary has been waiting eagerly to share with you what she had, I would not take much time. Mary is the principal specialist on capital markets from FSD Africa, and she would be sharing with us the best practice in terms of regulation for economic development in Africa focused on capital markets. So without taking much time, Mary, let me give it to you. And they are giving you a warm clap. You're on mute, but we can read your lips if that works. Okay.
Thank you. Thank you so much.
Fantastic.
Now.
Yes, yes.
So thank you very much, and good afternoon to you all in Addis. Greetings from very cold Nairobi this afternoon. I'm sure Addis is probably even colder, being higher up. So mine will be to share a presentation. I don't know if it's showing on your end. No, I don't think it is. So here goes. I hope you can.
If you could just put it on full screen. Yes, yes, we can.
Great. So I will just taking on from the earlier speakers, Dr. Tewodros, Dr. Tilahun, and Elsa as well. And building up on that, just talk about really why capital markets matter to us, region, certain principles of regulation that are also reflected in your own regulatory framework, and emerging developments on regulation. And as I speak, I think I'll also be speaking to various experiences that we've seen or experiences that other regulators have had in other markets in Africa. And I think there's a lot really to learn from each other through this discussion. But first of all, allow me to tell you just a few things about FSD Africa very, very, very briefly. I know time is short. So FSD Africa, we're a specialist development agency, and our role is really to build and strengthen financial markets across Africa. We say that our purpose is to make finance work for Africa's sustainable future. And so we do using the various tools identifying certain financial market failures that need to be unlocked in order to bring about growth opportunities. And I mean, all this is not an end in itself. The end is actually to support, Africa's people and its natural environment, to grow sustainably so as to support its own economic development. What we do, or the tools that we use to do the work that we do, are various. We have 5 broad tools that we use. We use grants, both returnable and non-returnable grants. We use a lot of data, knowledge management, just insights on different things around financial market development and capital market development very specifically. We do have an investment arm, FSD Africa Investments, that actually invests in high-risk businesses and catalyzes other capital to invest in those kind of businesses. A bulk of what we do as the capital markets team is to provide technical assistance for different aspects of capital market development. We have been privileged to be able to work with the ECMA to support development of some of the some of the directives that have been developed or are under consideration. And of course, we cannot forget, the role of networking, partnerships, and how we work is really across different relationships that we have across the continent. We work across 30 different countries that are highlighted in green, our priority countries. I hope you can see that Ethiopia is green on our map, meaning it's a priority country for us, and we've invested a lot, not just in the work that we're doing on ESX, but regulatory framework development and other initiatives. So just to focus our discussion a little bit on the topic really that I'm talking about, is about capital markets regulation for Africa. And beyond that, really to look at why then are we talking about developing the capital markets in Africa? Why does this matter? And I'm sure this has been discussed over the last 1.5 days, but just to highlight, of course, there's a long-term capital need for different, priority sectors, infrastructure, housing, many things. I had Dr. Tilahun mention, some numbers, for example, for Ethiopia of public, expenditure funding that is required. And I mean, the list goes on. Another thing I had him say, which is very relevant to this slide, is that external borrowing has, it reaches a limit beyond which it becomes difficult to borrow externally. And so therefore there's need to look at other opportunities, domestic capital raising, or within the region, for example, pooling other pools of capital, not just external, financing. And so those funding pressures, of course, impact how we are able to finance for development, to do very many things, including, financing urbanization, needs in cities, in different parts of the country. I mean, climate change really continues to be an area of focus, certainly a very important one for us. Capital markets are important for risk management, just to make sure, of course, that the FX risks and refinancing risks that markets face are mitigated. And of course, over-reliance on the banking sector puts a strain on the financial sector, the entire financial sector, because of course banks mobilize, or they hold deposits, short-term deposits, and yet sometimes they're required to fund long-term projects, and that already presents some asset and liability mismatch, which is a risk for the financial sector. And therefore capital markets are important to build resilience by ensuring that there is long-term capital matched with long-term funding needs. And of course, we have pools of capital in different parts of the financial sector in Africa, of course, Ethiopia included, pension funds. How are we mobilizing these funds towards capital market investment? Very important to consider for us as a region. And then diversification, I think I've talked about that. And I mean, overall, when we look at capital markets, when you develop capital markets, of course, it means that then livelihoods are improved, jobs are created. And really, it leads to inclusive private sector-led growth, which, as I had, is now the focus that Ethiopia, of course, is taking away from public sector-led growth. So just to this, we work across the entire ecosystem, and this will speak to a lot of what I'll speak about even as we talk about regulation. There are many parts of an ecosystem, a capital markets ecosystem. Of course, the enabling, regulatory framework, the policies, the regulations, but also the market infrastructure, and that's why, the work, what brings us to the table today, the ESX development is very important. And all those things exist because there's a market, right? That there are transactions that are happening on this exchange that has been enabled by the market infrastructure and the enabling environment in terms of the regulatory framework. So we support product development through supporting demonstration transactions. I know for a first issuer in any market of any new product, it is never easy coming to market. So we provide technical assistance for various aspects of those transactions. And then, of course, there are so many learnings and thought leadership. There's a lot of knowledge that can be shared. And as we say in our markets, I think sometimes getting these insights sometimes is not readily available. Data can be an issue, to access. And therefore, part of what we do is just to make that available to help evidence-based decision making and then policy making. So now let me come to the end of what I really want to discuss, and I'll just throw in various anecdotes from different markets and different things that we've seen in various places. One of the things I just want to say as I start is that, of course, capital market regulation doesn't really happen in a vacuum. Like anything else globally, someone else has done it before. And when you look at this International Organization of Securities Commissions, IOSCO, they have already set out what are the key principles of capital market regulation. There are three. One, as you would imagine, is protecting investors, and that's a very important regulatory mandate for any regulator. The other thing is ensuring that markets are fair, efficient, and transparent. And that's very important for a capital market, because I like to compare a capital market and a market, like a vegetable market, any market. Like if I'm in a market wanting to buy onions or tomatoes, it's very easy to see the kind of quality of a tomato I'm being sold, for example, because I can just see it. It's a product. It's like a car. You value it, you can see it, you can drive it. But for capital markets, of course, as we know, one of the things that makes it a bit different and why there's so much focus on this transparency, fairness, and efficiency is because you're buying into a share in a company. You don't know how it will do later. You're not inside the company. You're not governing it. You're not really the one running it, but you have invested in the business model, the narrative about projections and growth. And so that's what you're buying. And so you can't really see, you have to really rely on the people inside the company to give you this information and to be transparent about it so that you can be able to price the security as a trader and to participate in, either buying or selling it. And then, of course, reducing systemic risk, because capital markets do not exist or do not operate in a vacuum, part of a wider financial market. What's important to mention is that for all actually, emerging markets and frontier markets, capital market development is an additional mandate for regulators. For developed markets, having this mandate, this is not a mandate that they have explicitly in their regulatory framework. So I just want to highlight some, maybe principles or some aspects around best practice on capital market regulation generally, and then maybe just make some, anecdotal comments about certain examples. If you look at that image there, you're probably wondering, what is that all about? But I think earlier, our colleague from ECMA was talking about, some of the directives, including the directives that allow for self-regulatory organizations like the exchange. So in this particular case, of course, what brings us to the table is ESX. ESX will have self-regulatory mandate, meaning that the regulator ECMA will delegate certain responsibilities and can delegate certain responsibilities to the exchange. So here in that image, really, it's just to show you that there is a watcher, there's someone who is watching. The first small person is like the exchange. They are watching the market. They also have a regulatory responsibility, in addition to the fact that they are a market player and platform provider. But then you have the big man there, the ECMA, also watching the watcher. And that's important to remember that one of the things is that exchanges have a regulatory, they have delegated authority. They are kind of, that authority has been delegated, and they should also have the capacity to watch. So it's good that the small man has, the equipment to be able to watch the market, if I can say so. And so things like, the surveillance systems, their own rules and regulatory framework, there are rules, whether listing rules or rules for membership, how do people become, or brokers become members. That's very important, and it should be transparent as possible. The other thing is the efficiency, and we've seen that's a principle of capital market regulations, regulation globally. The efficient trading of securities, it should be efficient in terms of cost, in terms of time. It shouldn't take forever to complete a deal or to complete a transaction on an exchange. And that's very important because that attracts investors to invest there as opposed to putting their money anywhere else. If it's not effective, then if it's not efficient, then it doesn't make economic sense for them to invest in the market. And therefore, the exchange is being set up in such a way that those kind of principles on efficiency are put in place. Then, of course, there's a lot of infrastructure that sometimes, of course, investors do not see, but it's important because that's what makes the exchange work effectively. And so what that means is that, the central depository system and, surveillance system and other systems, including how the brokers and, intermediaries connect to the exchange and how they effect their trades. I mean, all that those are things that it's like plumbing for a bathroom or a toilet. You don't really see it, but if it doesn't work, it's a mess. And so that's very, very, very important. And as FST Africa, we are happy to be supporting ESX and the central depository setup processes in Ethiopia. So just to say that, exchanges do have a lot of authority. I just want to give particular examples of certain rules that are in exchanges. For example, let me give a good example. In the Nairobi Securities Exchange and in many others, including Nigeria and others globally, when there is a significant market movement, maybe there's something very drastic that has happened. Let me just, for lack of a better example, say that there's a financial crisis that of great proportions, like the 2008 or others. Maybe there can be a crash in prices. And so what happens is that for several exchanges, like in the region, they have breaks. So that there's a point beyond which, if like I know for the Nairobi Securities Exchange, if the price drops, goes up or down, I think more than 10% in value of the price of a security, they actually stop the trading. They stop the trading. They have authority to do that, for example. And that is done to kind of stabilize things so that it doesn't become a free fall and things like that. So that's an example of some of the authority that exchanges have. But of course, we know exchanges are in business as well. They make money through the trades that are going on in the market, but it's just balancing that regulatory role, but also their market development and really their business objectives. So those are just some examples I would give on exchanges. What about intermediaries? Because intermediaries are the ones that, of course, link the market and the trading on the market with the investor. If you and I want to trade on the market, we may not go directly, but we would use intermediaries. And so when you look at the regulation, when you look at some of the principles around the regulation of capital market intermediaries, there are several considerations, and I just put them in three broad buckets for ease of going through this in some structured way. One is some prudential considerations around what is the share capital, the capital strength of this entity, both in terms of actual share capital that has been put in and liquid capital that is available on quick notice in case of any adverse event. So these are very important because that, of course, is what makes it prudentially strong. That's what provides it. Even when you look at the licensing requirements, these are some of the requirements that would be put in place to depending on the activities of the capital market intermediary to show investors and really prove to the market that they have the financial muscle to support the activities that they'll be performing in the market, so that if there's any collapse or anything, if there's anything adverse that would happen, that they actually do have the muscle or financial muscle that is to be able to make good any losses. Then corporate governance for market intermediaries and indeed for any entity is very important. So a lot of regulations on corporate governance are put in place around the board constitution. In many markets, you find that there's a lot of prescription about how the board should be constituted, how many independent directors, different committees, and things like that. And these are things that the regulator actually does look at when they're inspecting the entity, because they will do that as part of their routine inspections They would be able to see, okay, this board meeting, how is it constituted? Is it just family? Is there, is there some independent director? And I think the point is not just to have an independent director to sign off and say, yeah, this is an independent director, check. I guess it's more to say, it's more to the robustness of just making sure that there is a objective corporate governance mechanisms in place. Then staff competency, very important. There are certain roles that you need, of course, qualified people to do certain things. I would imagine, of course, traders who will be trading on the exchange would have to be qualified, and many of them do have to have professional qualifications, professional certification, as indicated there, to be able to perform those functions. Audit and compliance functions are also very important to just make sure that there's a robustness in just the assessing the strength of that corporate governance and the internal operations of the entity. What about conduct of business considerations? Here we're talking about conduct of business and the front-facing, part of a broker's or a fund manager's or any other capital market intermediary's role. There are many things that they should do in the best interests of their investors. So much as they make money out of, commissions that they would get, they must make sure that they execute fairly. If there's a deal, if there's a transaction that they're executing on behalf of a client, if they have their own transaction, for example, and they are seeing a very, I'm using this as an example, if they are seeing a very, maybe it's a lucrative kind of a deal on the exchange or some opportunity that arises, one of the things is that, of course, they should do everything in the best interest of their clients as well, so that it should not be that their interests come ahead of the interests of the client. So if that request to purchase certain securities came in, say, for argument's sake, it came in, the client's request comes in before the company is queued into the system, then that shouldn't be manipulated. The client should be allowed to, that execution of that deal should go ahead nonetheless, even if there's a very profitable, opportunity for the entity that is executing that transaction on their behalf, for example. So it should be fair. It should be in the best interest of the investor. And then another thing is this issue of risk profiling or risk assessment of the investor, to be able to identify what is their risk capacity. Are they able, are they looking for risk averse opportunity? Are they risk averse and therefore looking for certain maybe more high risk, not high risk, but are they risk averse and therefore looking for lower risk opportunities in the market? So for example, I think I came across a situation where it was a clip I was watching actually in Ghana. One pensioner had put all their pension money in some, actually it was a Ponzi scheme, so being marketed as a fund, but really a Ponzi scheme. And so what happens there is then you wonder, first of all, forget the fact that they were investing in the wrong thing or they were guided to invest in the wrong thing, but even the market intermediary that was supporting that transaction, probably they should have been thinking to ask, okay, if this is pension, then you know that this investor is a risk-averse investor and should be a risk-averse investor, and even advise them accordingly and guide them as to what they should be investing in. So that risk profiling is extremely important. So what about the activities on the exchange, like capital raising? As we know, based on the example that I was giving, a capital market trading securities on an exchange is very different from buying a car, because you value the car, you test the car. But securities on an exchange, sometimes it's very difficult to see. You'll be relying on what you're being told about the way the company is governed, about the kind of industry it is in, about the sector dynamics for that industry, to be able to decide whether this is a profitable investment to make. So of course, disclosure is very important. It's very key in capital markets, and that's what builds trust. And so disclosure of material information to investors is critical. And material is, there's no scientific definition of what is material, but what is material is something that will make the price move. That means it's a very important piece of information. For example, if you hear, I don't know, the whole board of a certain listed company has resigned, that's material. It raises questions. We probably want to know who then is coming in next, and maybe if it's not clear, that already can make the price tank. And so that's why we see, when we look at international markets or even local markets, but let me say more international markets, because they react very quickly. We look at maybe what's happening on the New York Stock Exchange or other stock exchanges, when something, even it could even be the some of the interest rate movements that we've been hearing about from the Fed or other things like that, you see that you can see an actual blip in what's happening in terms of capital market trading activity, because it's those are sensitive things. So disclosure is very important, and the exchange also has a role to work, of course, with the regulator to just make sure that the companies that are listing have, of course, provided all the disclosure information that is needed. Then the exchange itself, of course, also has, as we said, a regulatory role. They actually do allow entities to list on the exchange. They have that authority. Then, of course, when a company is listed, there are many other things that they do as a company. They may want to issue bonus shares. They may want to issue dividends in specie. This means this is where a company, instead of giving bonus shares to its shareholders, it might want to give bonus. Bonus, other forms of bonus entitlements, they can call it that. So additionally, there is issuing additional shares, like if it wants to raise additional capital, but also mergers and acquisitions, which several companies are, once they're listed, that can happen. And so for these actions, I think it's very important to note that, yes, transparency is very important, because you want to know as a shareholder what price, for example, if it's a merger and acquisition, at what price is another entity offering to buy my shares at, and how did they arrive at that price, and what informed that kind of pricing? And so you look at valuation reports and things like that. And then moving away from disclosure issues, the whole issue of cost and efficiency of trading on the exchange is so important. And I know that, of course, the ESX is working on the rules around this in terms of what will it cost an investor. I think that's one of the things investors really want to know in terms of the total cost. There's a cost to the ESX, there's a trading levy that may also be due to the authority, a trading levy that may be due to, a levy or a payment that may be due also to the intermediary who is interfacing with the market. But then again, another thing is there are various rules that are put in the regulatory framework to prevent market malpractice. And there are so many kinds of market malpractice. Churning, this is where, for example, you have maybe a fund manager, they have a large portfolio of assets, large portfolio of securities, but maybe they just keep buying, selling to sometimes maybe they're genuinely taking advantage of some price differences that will enhance the overall asset value. But more often than not, they may actually be doing that also to take advantage of how much they are able to make as an entity by levying their own fees on maybe some of those transactions, which is not in the best interest of the investor. The investor in this case may be the end beneficiary, the pensioner, or the person who's contributing to that pension scheme. That's just an example. Insider trading is one that is very important to watch and very difficult to investigate. Even in very developed markets, they say that it's not easy to investigate. You have to really follow who was the insider, who had some inside information that was not disclosed, and then took advantage of that information and maybe sold their security or bought additional securities before the price went up. Because of course, as an entity, when an entity is announcing that maybe it's acquiring or being acquired, that's very material information. And usually those things don't happen in a vacuum. There have been considerations about doing something like that. So in the background, there is an anticipation of that kind of announcement being made. But what usually happens, insiders like board directors who are involved in those discussions, many times there's a freeze period where they are not supposed to be trading in those shares. Because of course, if I know as a director that we are having some certain discussions around a potential merger and acquisition, what usually happens, the price may actually go up. But it should go up when that market information is out there. And then everyone can react to that and buy or sell or do whatever they choose to do. But as a director, if I choose to buy when the price is low and not everyone knows what I know, that's insider trading. And it's in many markets, like we've seen that in Kenya and other markets, that when there's a violation in some of the regulatory frameworks, it's a very punitive penalty. So even if maybe they made 10 million birr, from the transaction, like maybe I'm a director and I get into this and I make 10 million from the transaction in an insider trade, I am meant to pay as a penalty 2 times or even 2.5 times more than that. So it's meant to be punitive, and that also happens. We've also seen that in regulatory frameworks in other markets as well. So I think I won't go into all of them. There's another one there called pump and dump, where market intermediaries or players, doesn't have to be market intermediaries. It could be an entity that owns securities on an exchange, but they are, you know, how can I put, just like the word suggests, like they are either selling all the securities that they hold to kind of bring down the price, and then maybe buy it when it's low or something. You know, it's a very manipulative practice, and there are very many different other manipulative practices out there. So the exchange is very critical because they have a surveillance system, a surveillance function. They work closely with the ESMA in just making sure that they are watching the market and collaborating on any, you know, illicit activities that may be going on there. As I say, sometimes these are very difficult to detect, but good technology, and you know, usually they say when you trace the money, you'll be able to see who was doing what and be able to arrest the situation. What about funds? So this is a different product. In some markets, funds are listed, depending on the type of fund, some are not, but I'm talking about it because it's an equity instrument. And so I'll just very quickly fly on this. Basically, again, I think now you probably have gotten the gist, some of the principles, of course, around governance mechanisms, who is doing what, who is holding the money, who is advising on how the money, the fund money is being invested. And also, it's very important to have transparency on the underlying assets in the fund structure. So for example, if I tell you that I'm a fund manager and I have a money market fund, typically you should be able to know where that fund is invested in. So it may be government securities or fixed deposits, but you need to know where it is being held. So that if I tell you that I put it in real estate, we all know real estate is not liquid, and money market funds are meant to be liquid. So you should be able to cash in when you need your money. You should be able to exit when you want to exit, redeem, you know, your investment whenever you want to do that. But if it's not transparent where those underlying assets are and what they are, then of course there's a confidence problem. And I've seen this particularly in Ghana. Not so long ago, they were dealing with a big crisis where a lot of, there was lack of transparency really around where some assets were being held. So assets, instruments being marketed to investors as funds, but they are not really funds. They were actually Ponzi schemes. There's one, you can read it, it's all over the internet, called Men's Gold. It was one big one that was closed. And many investors lost their money. And basically, of course, as an investor, I need, this is information I need to know, but investors maybe were not that savvy to know that that money was not being invested in any proper fund structure. And so there were really toxic underlying assets. And of course, as you can imagine, for any Ponzi scheme, and as happened in this case, it actually fell apart and people lost their money, and it was a major issue that the Securities Exchange Commission had to resolve. And that dents the market confidence, and that's market confidence for capital markets is so important. And that's why this issue of transparency just keeps coming up for capital markets. It's just so important. For banks, of course, prudential regulation is like the key thing, but for capital markets, transparency and disclosure is critical. So again, coming back to disclosure, you know, what is the cost of investing? What is the cost of moving from one fund to another fund? How can I exit? And also the other thing, who's holding the fund? Is it a custodian? And how is that fund wound up? All that should be very, very clear. I'm almost coming to the end of my presentation. I think we've talked about mergers, acquisitions, and the importance of disclosing. Insider trading we've talked about. So anytime there's a merger and acquisition, I think these are the things that in the regulatory framework, in the minds of regulators, whenever there are mergers, acquisitions, takeovers happening, there's a lot of focus on disclosure and timely disclosure. So here we are saying if it's material information, it should be disclosed within 24 hours of happening of the event. So if an offer has been made to acquire Ethiopian Airlines, for example, that's not something that should be kept quiet over a period of time. It's something to be announced immediately so that investors in that company can now start taking positions and the price then starts moving and to reflect the news that has been released. Fair valuation is very important because investors want to know, at what price will they be bought out in a takeover, merger and acquisition kind of situation. I think this is my last slide. We've been talking about regulations, just different principles governing different things, and I'm really flying over it just to bring, just to highlight a couple of things, but also just to highlight some emerging development on the global regulatory plate, I can call it that. And I mean, for some of our markets, of course, we are probably thinking about other things. I mean, of course, Ethiopia right now thinking about setting up the regulatory framework, establishing the exchange. But as you can see from the IOSCO, one of the recent media releases from IOSCO of 23rd of May, one of the things that they've done is to set, I hope you can see, I don't know how big it is on your end, but at least I can read the title there is IOSCO sets the standard for global crypto regulation. So there's been, I mean, regulators have not really been united in terms of their position on regulation of crypto assets. So that's something that IOSCO has, I think, wants to pronounce itself on, and therefore has issued some paper, a consultation paper with some recommendations. So what they do is that they issue that and they get comments from different regulatory entities that will inform the final standards or principles that would govern the kind of regulatory frameworks that regulators may want to develop. The last thing there is something that came out very recently. The International Sustainability Standards Board recently issued certain standards there on sustainability related disclosures. Again, more on disclosures, and now this is more disclosures around sustainability. And I guess as a world, that's really where we are going. And I think we have phased approach over time, but these are the new kind of developments coming out. And different markets are different. Different markets are dealing with different things. And I think it's important to always be aware of where a market is in their level of development. Right now, Ethiopia is setting up the capital market. So your focus may be very different right now compared with, of course, other markets that may be thinking about crypto regulation right now. Like for them, it's the hottest issue that they have to deal with. But having said that, I think I will stop there and happy to answer any questions or take any comments after. Thank you.
Thank you very much, Mary. The team is clapping for two reasons. They would tell you the latter one, but it was the interesting session as well. But I think we have a question and answer session next. So we keep you online for a few minutes, if that's okay. And to moderate the session with Q&A and bring back all the people who have simply put a lot of information on the table and run away, including Dr. Tedros, Dr. Lahom, back to the stage. I would call upon Ms. Sonia Izomaj, Chief Innovative Finance and Capital Markets Section, ECA, to the stage, and give her a very warm hand.
Good afternoon. Okay, so let me call back on the stage Mike, Tilahum, Tewodros, and we already have Mary online. So this is the last session here with us, okay? But I know you have a lot of questions for Tewodros, so obviously this will keep us all alive, right? Oh, no one is coming. Oh, they need a hand, please. Mike? Yes.
Well, regulation was not an easy topic, right?
Thank you. So while you are preparing your questions, I have a few questions for the panelists. And please, we will try to keep it short, sharp, so that we can have also a round of questions with the panel, with the audience, okay? So maybe I will start with Tilahum. As capital markets grow and become more interconnected with other parts of the financial sector, as well as with global markets, mechanisms to coordinate with other domestic authorities, including the central bank, and with foreign supervisors are crucial, right? Some analysis point to a lack of supervisory capacity as a major challenge for many emerging and developing markets. And this is mostly due to the lack of qualified staff, sometimes funding issues, and challenge to the independence of the supervisory authority. So my question for you is, first of all, do you, share this analysis? And how can we ensure that these potential challenges are not addressed as part of the ESX project? Thank you.
Thank you, Sonia. Well, from the question, you can see we did not give her these questions, obviously, right? So otherwise, she would have asked us a very easy, inconvenient questions. And would have meant perhaps for Solomon if he was here.
Apologies, Dr. Tedros. I know your train of thought is running, but before people get scared, Radisson Blu is going to have a fire drill in 10 minutes. So if you see the alarm, please do not run away. They have advised us to advise you so that you don't run away. That includes the panelists. Sonia, apologies for that. Okay.
We would have used that as an opportunity, especially me. So yes, so perhaps more perhaps relevant question that you would see from a regulator's point of view, right? Coming as a new regulator, the authority is better placed in terms of seeing what capacity building looks like for itself. But for the moment, because we sit together, and these are very close colleagues and friends of ours, I'll also address that. So it cuts across. So what I would use is whether or not capital markets is different from other regulatory areas, right? So we regulate education, health, etc. In all other circumstances, we face this similar challenge, introducing new concepts, trying to build institutional capacity, and trying to build trust. And as a market, we've been very perhaps frank and too honest in that we do not expect to bring sophisticated products to the market. So we've kept time and again to say our market would be plain vanilla products. In fact, much plainer than what you would have assumed in other markets. We said our market is too early to work on corporate bonds, but perhaps maybe commercial papers too. We said we need to work on money markets before we even gravitate towards in having a more full-fledged and developed even sovereign debt market. Same thing on equities. So we said this morning, I didn't want to bore you with a lot of products. Although at the team, we're very ambitious. We'll tell you, we'll serve the OTC market, we'll serve the crowdfunding platform. We have a plan to bring DLT and blockchain down the line to make sure our markets are integrated and efficient, because that's what the technology is heading towards. We want to experiment a lot on some products through regulatory sandboxes, etc., etc. But we cannot survive as a market on a lot of experimentation and risking too much of our reputation. So we're okay and comfortable with a regulator that's trying to build the market one by one, step by step, but it also applies for other regulators. So if I may extend a bit, Sonia, your question, this works the same for the central bank. Minister of Finance, we don't expect them to issue, a dozen bonds in the first year. We don't also expect to easily be lenient on other practices that the banking sector or the financial sector operates. And same thing with the revenue authority. So we allow them to understand what each products are and what kind of tax incentives and support we need from that regulator. So you will see, for instance, we want to talk about exchange funds. We want to talk about REITs, but understanding what the tax regime for REITs is going to be new for them. But then down the line, we will start that conversation. and I see Stefanos here, which have been frequently engaging with them. So regulatory capacity for me, just like we did, is what you call baptism by fire. You can only learn as you're experimenting with the products, and all you need to do is to be very gradual. And then I guess from the market side and perhaps from the service provider side as well, we're willing to be patient. That's what I can say. Thank you.
Thank you, Tilahum. It's true we mentioned, the rights of investors. It's important for us to build like a fair and transparent market, right? So for investors to participate, they need to make, they need assurance that the mechanism are in place to ensure the rights are protected, and in case of any breaches, to such rights, there would be mechanism to enforce remedies, right? So Michael, my question, for you, do you consider the current regulatory framework and also oversight mechanism in Ethiopia to be sufficient enough to instill investor confidence?
I wish you had asked Tilahun that question. I think maybe if we step back, it's such a new thing, new area. I think one big advantage we have is building the authority, the exchange at the same time, which is usually not the experience in almost anywhere in the world. A lot of times the exchanges come first, they operate as the regulators, and then the authorities come in later. So one advantage we have is we can understand the rules. We have the best practices from around the world, and we can design a lot of the rules, both the exchange rules as well as the authority rules together. So, this is obviously my viewpoint. It's hard to answer, but I think the investor protection regime, we talked quite a bit yesterday in terms of how public offers are going on right now, without getting into detail, but it's highly unregulated. So you're almost starting fresh and trying to regulate the listing, offer process, etc., from scratch. So I think we will definitely, both from an exchange side in terms of ongoing compliance, regulatory oversight, we will work hard on that in our rules. So the exchange will be a proper SRO, but also the authority has a lot of directives coming out. One of their main mandates, I believe, is investor protection, literally. So I think the environment will be created. There will be growing pains, I believe, because it's quite a switch from where we are now. A lot of companies are offering shares directly to investors. And sometimes these do go sour because there's a lot of lack of information, prospectuses are not required, etc. So I think we have to look at it in two ways. It's hard to answer saying, is it ready today? But I think going forward, it will be better, is the way I would phrase it.
Thank you. Theodros, during your presentation, you emphasized the importance of moving toward a market-based system, but also removing financial repression. Considering the global context, and we know all the challenges, uncertainties, it has been very difficult for African countries to tap international markets. Are Ethiopia's initiatives, current reforms on track, for such project?
I would say yes.
This is a good news. I think like our macroeconomists and our financier here are going to be on the same page, right?
Yeah. I not. I was going to say yes, but and bring in all of the. No, I'm not going to do that. I think with respect to Ethiopia's policy, regulatory framework, both in respect to international conditions and within locally, has been well diagnosed in my view. And I think there are sensible reform ideas, put forth. It would just need commitment to just implement them and move through them and see how they result. I think the challenge faced over the past 2-3 years is indicative that those reforms are actually useful to implement. I can give you a number of examples. One, I think there is a lot of skepticism on even the incentives, whether incentives work in Ethiopia. do people respond to incentives in Ethiopia? Does economics even work in Ethiopia? Is a very common question that people have. And I'm here to tell you that the basic principles of economics do work. People respond to incentives. And one example I can give is in 2019, the central bank increased gold prices to match parallel market rates. And in just a few months, gold started flooding the official market compared to, and people were saying, even if we change this, exchange rate, whatever, people will not respond to market incentives. But we know we have good information that people actually respond to incentives. So I think the move towards market-based with sufficient regulatory capacity and flexibility within the regulatory capacity to respond to emerging issues. So it's not just having the regulatory system in place, it's the ability, the capacity to respond to emerging issues, because we will figure out, and as Tale said rightly, it's baptism by fire. You have to do things to learn from them, and then, but important to quickly respond to those things. Other than that, I believe that we are on the right track. Thanks.
Thank you. So maybe I will let Tilahun react to what you have just said.
Perhaps I'll connect it what I was trying to say earlier in terms of how a market grows to kind of fill in a gap. Because you mentioned, I was interested in the fact that you mentioned foreign investors. You said that, right? Or is it my head that's speaking to me? In a way, I want to listen to your question. Yeah, so you want to prove perhaps to our regulator, you just imagine the macroeconomic committee. If you want to have a reform towards, how you attract foreign investors into this market, because that seems to be, if you have actually checked, maybe NCBA colleagues will tell you, many of the markets that we went to have been, I wouldn't say consensual, but have been very comfortable in the fact that the market was working, especially in terms of attracting foreign investors. The exchanges were getting the revenues they wanted. Just as a reference, if I'm not mistaken, NSE gets more than 15% to 20%. What is that, Mike? From data, is it? Nigeria is about 30. So even just data has been a very significant source of revenue, and whoever is buying the data is not the local investors. At most, it's foreign investors that are paying for that data through Bloomberg. So you will see that there's heavy reliance on foreign investors, and as a market, one, we don't have them yet, but we also don't want to significantly rely on foreign or at the start institutional investors. So you want to, first of all, exhaust the potential and capacity that exists at home. If it is a pension fund that you have at home, you want to create a second, a third tier of a pension structure. That's something that we're really interested in trying to advocate. Just imagine if the government would provide a tax incentive if 1 or 2% above whatever we're contributing through pension for pension contribution today is exempted, but it's not locked in the current pension fund regime, but rather they can be invested by the pension fund itself, or but maybe the insurance companies or you guys from the financial industry, and they could be invested on a more, what you call at least aggressive instruments and more of the better yielding instruments. So there is a lot of potential to maximize whatever is available domestically. And Teddy was careful to tell me earlier that he was not trying to Excellent. So I should finish before 5 minutes then, and allow you the question. So in a way, we should be careful not to perhaps expect too much. Okay, so, this is, A bit louder. So the idea is exhaust the potential that we have domestically, and then seek those reforms. And in terms of timeline as well, there is no rush, even if we want to, from government in terms of current account and capital account liberalization. Thanks.
Thank you. I will turn to Mary. I hope you can still hear us. Please do not run away. This is just an exercise, okay? Thank you for your presentation, and maybe briefly, what will be your policy recommendation to ensure the right balance between regulation, financial stability, innovation, and growth in this, in regards to the ESX project? Thank you.
Thank you, Sonia. I think my quick reaction or response to that is really that it's important to consider these things. I mean, you talked about financial stability, regulation, and growth. I think it's important to have an ecosystem approach when developing, I mean, any subsector of the financial market. And what I mean here is that it's very important to have a cross-sectoral, intergovernmental or interagency approach in terms of being aligned on whatever reforms or whatever capital market and financial market sector development initiatives that any market has, and making sure that everything is speaking to everything else. What I mean here is that, I mean, of course, when we talk about capital market development, there's so many components that interface with other parts of the financial market. We're talking about, of course, the macro, the policy environment at the macro level, and central bank interventions that also dictate the kind of interest rate environment that has implications on whether, as an investor, I will be interested in investing in the capital market or not at all, because of if I know that I'll get good pricing on securities, high interest rates for government securities, then I have no incentive to look for any other riskier assets anywhere else. So I'll just do the risk-free assets or risk-free rate that is being offered by the government or the central bank through those securities. The other thing is, when you look at who are the investors, of course, there are a raft of retail investors that can participate, but also important to be looking at institutional investors like pension funds, how to grow the pension fund industry, and what kind of policy reforms are needed to make that happen, to make that capital grow, to increase that pool. I mean, that just means increasing, that availability of institutional capital that is available. And together with that, of course, the tax environment. There are very many tax considerations when you look at capital market products. So, of course, capital market products, there are different types of products, as Tilahun has mentioned. And to support innovation, of course, then you need to look at policies that provide for certain tax treatment that enables issuances of certain products like REITs or others to make economic sense to the issuer or even to the investor. If that doesn't happen, then of course it means then that there's no reason why I would move my money from wherever it is sitting to move it somewhere where I know that there's no pass-through tax treatment, for example, and I'll be taxed at many points. It may not make economic sense. So I think for me, what I see is that on the one hand, and I think this has been alluded to, regulation needs to be nimble. It needs to be focused on the objective. So it's not just about saying, okay, this one complies with this, that, and the other, and therefore we are okay with this. I think it's to be open to opportunities and to see where they need to be flexible. When you talk about innovation and growth, is looking at growth holistically. So you're talking about the capital market. It cannot grow as effectively as possible if some of the macro conditions are not well aligned to that capital market development objective. If the tax environment, the policies around that are not conducive. So it's a whole ecosystem approach. And so I think I like the discussions we've been having, because I think there's been a lot of that interconnectedness, even when Dr. Tewodros was talking about the wider macro issues. And I think those should never be, they should always be top of mind. So thank you.
Thank you, Mary. I will now open the floor for questions. Please do, raise your questions. Do not leave with them. So this is your final opportunity to interact with the panelists. Are we still alive? Yes. Okay, good.
Okay, since we are not going out, let me just continue. When Mary Online was presenting, she make mention of crypto something. I don't know, maybe Dr. Theodros or Dr. Talahon may give some perspectives in regards to the Ethiopian market, as we are just newly coming to the trading business. How are we ready on these things? Is actually in some African countries it has affected business a lot, especially in trading. Those that deal. So I don't know how the regulation, how it is regulated, but how ready is the capital market to make sure the crypto currency things and the blockchain tradings are not going to affect our capital market. Thank you.
Thank you. Do we have another question? So maybe I will give us the floor to.
So exactly the reason why I said we've limited ourselves to plain vanilla products and plain vanilla markets. Just for the sake of clarification, I think also Mary will address it later. Crypto is at least from regulatory point of view, treated in some markets as a commodity, or you'll take it as a currency. But for now, it's not a capital markets product. Digital tokens, securities can be capital market products, but we'll discuss that later, right? So a share, you can tokenize just for the sake of technology, the way how it's stored, transferred, traded, etc. We can innovate on that based on DLT, based on blockchain. And the fact that it is trading, if it's introduced in our market, the fact that it's trading on our exchange will not be mostly from investment, legal, security point of view, anything different from other securities. So it's okay to tolerate, to a certain extent, to use DLT to the extent it is modernizing our markets and our exchanges. Just to explain what we have in mind, and this is very gradual. We will not be introducing this the first day. What we have in mind is, do you remember this morning I mentioned about crowdfunding? We want to bring an SME that is trying to raise, say, only 10 million Ethiopian birr, and we would like to allow this, say, up to 1,000, 2,000 investors can come in and chip in 100 birr. Now, the way how our market structure is created, it would be too inefficient, costly, and also from regulatory point of view, but at least costly for the issuer to actually pass through what we're talking about in terms of, registering your securities, forming a share company, coming to the central securities depository and registering your securities, and then bringing that to the market. Each 100 birr would be really a bit of, say, too small to actually serve a purpose in this market, and or too costly. So DLT helps a lot on that. So the moment a security is issued, the exchange could use what you call DLT, blockchain technology, to create a smart contract, issue securities for the investor, and then down the line, if the investor wants to sell, we will call that digital security, and it will allow trading. So to the extent it brings innovation, efficiency to the market, we will think of it. But other than that, when we say DLT or blockchain, We're now mixing it with crypto. To the extent we know, trading use of crypto has been banned by our Information Network Security Agency and also the central bank. So to the extent they guide us in terms of future use of digital currency, we will remain down the line if digital currency is used nationally and it becomes part of our currency regime. Yes, that will be introduced, but it's not up to us to say what are we going to do about that. Yeah, thanks.
Okay, I don't know if any other panelists want to react before I give the floor to Mary. No, so Mary, do you want to add something?
I think Tilahun has said it well. What I just wanted to say, which is mentioned, is that part of what I was saying earlier about this ecosystem approach is, of course, if the regulator, if the central bank has banned, the use of crypto assets or digital assets, currencies in a market, then even considering any other form of derivative of an asset that is derived from that underlying digital currency will not, I mean, the capital market regulators do not consider, they do not go beyond that. I mean, so there's that interconnectedness in terms of the country's policy or the central bank's policy around some of these currencies, and that also informs then what other innovations can be allowed to thrive in a market. So, but I think just to go back to the point about, I guess, different markets are at different levels of development, and it's important to just recognize that. So considering where the Ethiopian capital market is in terms of the nascent stage and setting up, so priorities may be very different and the focus may be very different. I mean, there's an opportunity to leverage on the technologies that Tilahun has mentioned, but I think it's very good to be conscious that I think it's good to be realistic about the kind of road or the kind of car that you're building to drive. On what kind of road will they be driving? If it's a Ferrari on a dirty road, or a dirt road, I mean, it's better to build the market, progressively and have more complex products or more complex, platforms as the market develops. So I think that's what I'd say.
Thank you. Final round of questions. Please.
Okay, thank you so much. My name is Fraser from the National Bank. So I do have two questions. The first one is on the issue of climate and environment. So these issues have been becoming bigger and bigger globally, and a lot of restrictions are coming up on the companies in terms of getting access to market, including the financial market. So my question is, when we roll out, the stock exchange market, to what extent is the market and including, the regulatory authority ready in terms of addressing these issues? Because at the end of the day, particularly for getting access to, foreign capital, it's becoming more, demanding that, the market, particularly the issuers are, climate conscious, in terms of, adopting ESG standards and the like. So to what extent are we addressing this issue, which is coming up, bigger in the very near future? So that's one question. The second question is, to what extent will the stock exchange and the regulatory authority are preparing toward this, developing products that are Sharia compliant? We can start with the money market, but still there is an active demand for such instruments to be in place in the financial market, along with the conventional instruments. And as you know, if you are considering, for example, the financial system in terms of being institutional investors, there are some that are Sharia compliant financial institutions. Definitely, they need a venue to invest where there are products that are consistent with the Sharia. So, to what extent is this issue being worked out? So these are the questions. Thank you.
Thank you. Maybe Tilahun, you want to go first?
Thanks, Ato Fraser. Let me slightly touch on the first point, but for anything that is climate friendly, relevant, Victor is here in the room to guide us. And I'll be very frank and blunt a bit. As a market, as we develop our market, it would be significantly investor driven. And no matter how important those topics are, sometimes I think we'll fall short of delivering on those, especially climate objectives, if the investors are not sufficiently motivated. So now that we're speaking mostly about local investors and mostly retail, you'd have to question whether or not issuers will be motivated to provide products that are packaged in that manner. But then institutional investors could be different and a bit of a story. But then, yes, so one product that we have in mind and we would really like to develop down the line is issue of green bonds, or usually the thematic instruments. It could be gender as well. But again, you want to incentivize those instruments through a bit of institutional investor base, sometimes DFI based investment. So what would ideally would be an SOE that's under EIH trying to issue a green bond, and then it attracts a foreign investor, or otherwise a domestic investor that would invest together with a foreign investor. But again, like I said, if you do not diversify the investor base and the investors are not conscious of this subjects, it will be hard to push this instruments. I think this is a very frank statement, because you would see when attention to climate change, environment topics, or even social topics disappears in the West, these topics also disappear, and it shouldn't be like that. Domestically, that base needs to be built in, and only then you can capitalize on that. I think we're very optimistic on the social side of the story, but I think on climate one, it's good to start with a very frank statement. But to the extent the investor base exists, I think there is a lot of potential. Within EIH, for instance, we want to work around carbon markets, voluntary carbon markets. This is something we're studying these days. We will see to what extent we deliver a solution, a product. Usually these are voluntary instruments. It's an auction market, so it needs a lot of issuer intermediaries in terms of evaluating the credit scores. But then bringing the investor there is not difficult. It's not that difficult. There is a lot of appetite and attention. Even our own airline should be interested, because there is a particular segment around that. So rather than buying those credits abroad, there is a lot of market that they can support. But then, like I said, when the opportunities exist, we can capitalize on that. Same thing on the Islamic instruments. Whenever we see, for instance, some of the I don't know how many of these banks are here, but yesterday there were more. When we see, of course, this is very not kind of us, but when we see Islamic banks not having as much opportunities to invest on the conventional instruments, we say this is a good news for us, especially for the capital markets, because there are really non-interest banking friendly instruments, and developing a sukuk is not a big deal. You just talk to Ivan and he'll tell you everything that you need to know. But here is a very good example. So one is, of course, for Fraser and his team to also consider these products as instruments for government, because these are not always private sector commodities. Governments issue sukuks. Governments can also attract those investments. Central bank can issue a sukuk. But then think of more municipal bonds, regional bonds, and then you convert them to sukuks, because if a private company cannot do it, at least it's easier for governments to do. So just pick any region in Ethiopia. They have a plan, either they borrow from central bank or Minister of Finance or via the method to build a hospital. What a sukuk will allow you to do is, well, you build a hospital through a SPV, but make sure whoever is going to that hospital whether or not it's a community that you're trying to support through community health insurance schemes, or these are government employees that use those hospitals. You support that investment and that funding and their expenditure. But what that sukuk needs to do is to be able to make a profit and pay this SPV. And that's how the sukuk could be funded. Now, the fact that this money exists and this funding is available, and there's a lot of demand on the other side, all at the same time, will tell you all we need is a few market players to create these products. And then it's not going to come anywhere but from the same institutions that are sitting on that funding. So they should come in as advisors, share advisors. So that's, we just discussed this morning. CMA would be coming in and trying to license share advisors. But down the line, the product needs to be created by those who knows it and understands it. What's the role of the exchange? Is to list those sukuks. So our role usually is very much what you say, indirect. Sometimes we instigate, we develop capacity, but product development, communicating that product to the right stakeholder is usually left for service providers. And if you don't do that, then what else you're going to do? Because Ethiopia, half and half almost of the population is Muslim. There's going to be a lot of potential in that area, especially in regions where there is a lot of Muslim, in areas, Muslim population. There is a lot of capacity to raise products and provide returns in this market. Mike, you wanted to add at least in the sukuk area?
I think you've summarized it very well. I think the key point to say is the exchange is more of a platform, but at the same time, it does have a role in developing the market. So I think working with FSD Africa, Mary probably has some perspectives on this as well, to give a Pan-African view of how these have evolved, both sukuk, both Islamic and the ESG. But I think the exchange in the early years will play a large role in market development. But the actual platform, the mechanical part of listing the bonds, a sukuk bond or green bond, for example, is not that different from a conventional bond. It's very easy to list on the platform. That's the easy part. But actually developing the market is going to be a joint effort, really. Development partners, actual local intermediaries, etc. So I think that's the only point I wanted to add. I don't know, Mary, if you want to give a perspective or viewpoint, if you're still there.
So Mary, please, as you are doing so, just share your final remarks, comments in 1 minute so that we can wrap up. Thank you.
Thank you, Sonia, Mike. So I think what I'd say is, I think you've alluded to that, Mike, about these like when you look at thematic bonds, whether Klein, Green, Gender, and others, they are really they're riding off the already existing regulatory framework or trading mechanisms for normal plain vanilla bonds. So what I'd say first is, I think the first place to is, of course, to continue to build and to support the ESX in building all that out, whatever is needed to support the trading and through the establishment and actual trades of just a normal plain vanilla bond. Because then from the back of that, then you have you have the platform to be able to issue other bonds. But what I'd say about thematic bonds is that, and I think this was alluded to earlier, there must be investor interest. So you have to sound out the market. Institutional investors have to see the need to want to invest in this. And a lot of times in our markets, what I find is that investors are looking for a return. I know that in international markets, they are looking for a return, but increasingly now, sustainable impact. Well, I think in our part of the world, if we can be honest, this is something that we will continue to build, we will continue to see, we will continue to see that, building and changing over time. But the reality is that when you talk to institutional investors, pension funds, I guess even a retail investor out there, they want to make money, they want to get a return. And where the return and the impact objective are aligned, then of course it may be during the market founding for some of these issuers, then they would be able to make a case and the capital will flow there. But at least I know for international capital and impact funds or DFIs, I mean, they do make a strong case for investing sustainably and therefore are able to anchor invest some of these thematic issuances. But I mean, the long and short of it is that right now, you may want to just continue focusing on building the foundations. I think what we find in the market, we are increasingly seeing in the region leaders, certain corporate leaders in various markets who really want to show their commitment to sustainability. So you find that some have a very strong gender focus or a very wanting to continue to build a very strong climate focus and to just carve themselves out as market leaders in the market. And therefore they're the ones are many forefront of trying to come to market with some of these issuances. But I think for the investor, at the end of the day, they want to see that the return and the impact are aligned. At least I would say that for most of the regional institutional investors. And so it continues to be something that, we continue to engage with markets, different market players, just to show the need or, the opportunity that there exists. It's a matter of time though. I think those objectives will be aligned even for institutional investors, the way we are going globally. The other thing, I mean, my part in short really is to say that I think, well, the ESX and other stakeholders in Ethiopia are really, I like always to say, making history, because this is when you make the foundation and you get the foundation right, then really you have a good runway and the flight really is off to a good start and a good takeoff. And I think that's a very critical part that we're in, and just even being able to sequence correctly, considering what products to bring to market, but just making sure that the framework, the listing rules for the ESX, the platform, and even the rationale, the policy rationale for different things is really aligned. And for me, I underline the issue of ecosystem approach. I think that's just a critical thing, to just look at things very broadly, and different ecosystem players being aligned on that. So thank you very much.
Thank you, Mary. In 1 minute, Tewodros, any final thoughts?
No, I would just like to say thank you for not asking me any questions. But yeah, I would just like to say, I know that I've been speaking about some of the challenges in the macroeconomy. Usually macroeconomic issues are transitory. When you have your policies aligned right in a relatively shorter period of time, things will fall in place to create the incentive environment. I'm hopeful that we'll embark upon those reforms. Now that the shocks seem to be subsiding, we want to, I hope that we'll do that. That would be critical. I want all of us to, particularly ESX, the ECMA, to lobby for the proper working of markets. Otherwise, it will make their jobs immensely difficult to play in such a difficult environment. But I think building the capacity to understand the ecosystem very well, the economy is also essential for the institution building itself. But I'm hopeful I'm actually very confident when I see the team and how things are progressing. This is one of the things that I can say that has progressed really, really well. So I just want to say, end on that hopeful note. Thank you.
Thank you. So if you still have some energy left, please give them a hand. So bear with me again. This is the last time I will say that. I'm just going to close this today workshop. So distinguished, and thank you, Mary. I don't know if Mary is still online, but yes, thanks a lot for your presentation and for your time. Closing remarks, and then we are free. Distinguished participants, dear partners, dear colleagues, we have come to the end of this today workshop. Over the 2 days, we have learned about the ESX project, the different segments of the capital markets, money markets, fixed income markets, equity markets, but we also discussed the regulatory framework and heard about experts about their experiences. The potential contribution of capital market to economic growth in emerging and developing economies is even more relevant today, given the challenges of the Sustainable Development Goals. There are huge financing gaps in key strategic sectors that are critical to achieve the SDGs. And we already know that public finances are limited to meet these needs. We have less than 7 years to achieve the SDGs. And unfortunately, we are not on the right track for a number of reasons. One being, the succession of crises that have hit us hard. Why capital markets? I think well-developed capital markets mobilize additional savings into the economy, making more capital available to companies, which may then in turn create jobs and facilitate real wage growth. Just imagine 120 million Ethiopians being able to save $1 per month. We are talking about the potential of $120 million that can be injected into the system to support businesses in developing their activities and creating jobs. We are talking about households being able to save money for future projects and needs. So we have actually the opportunity to create a virtuous circle that will ultimately benefit the economy as a whole. ESX offers the opportunity to transform the lives of Ethiopians by modernizing the financial system. There are prerequisites, however, for the development of capital markets, and we discussed that during the 2 days. 1, macroeconomic stability. 2, a certain level of financial sector development. And 3, a sound legal and institutional environment supported by an adequate infrastructure. What do capital markets means to us, means to you? On a micro level, well-developed capital markets constitute an important source of financing for companies. From the investor perspective, capital markets offer investment opportunities and risk management tools. And finally, besides economic growth, well-regulated and supervised capital market may enhance financial stability. What is the rationale behind developing capital markets? First and foremost, to create inclusive and resilient economic growth. Yet, this is not to say that capital markets come without risk. We therefore need to make sure that the entire ecosystem is prepared. And we should therefore, and together, build capacity of market players. We are talking about investors, financial institutions, issuers, and also intermediaries. Design conducive rules and regulation. Set up a solid infrastructure. And of course, create appropriate financial instruments. As we said yesterday, this is an opportunity for Ethiopia to learn from the experience of other exchanges and make a leap forward in developing its exchange. ESX will have to address the needs and requirements of the common market under the AFCFTA, of course. One of the main outcomes of this workshop is to get your feedback, concern, and need so that they can be taken into account during ESX development. This is really important. You need to know that the ESX team, the ESX team, right? So don't hesitate to engage with them. And rest assured that ECA intend to continue supporting this project throughout its development. I don't want to commit other partners, but I'm pretty sure that they have a vested interest in continuing to support ESX. This project will require considerable resources. So I also appeal to potential partners to join us in its development and to witness the impact of financial modernization on the lives of Ethiopians. So what are the next steps? The ESX team will continue to work on the implementation of this project, which means acquiring the necessary infrastructure, organizing capacity building workshops and trainings, and also work more closely with regulators and all the relevant authorities to ensure a supportive regulatory environment. I'm also confident that the ESX project team will communicate on due course on future developments. The phone numbers have been communicated, right? So don't hesitate to join them day or nights. Maybe not during the nights, okay? Maybe not during the nights, but of course they're available. This is your final exercise. I would like to ask you to open your hearts once again for a clapping exercise. So I would like first to express my sincere gratitude to our partners for the support and contribution to the success of this event, namely EIH, ESX, FSD Africa, UK8, ECMA, Bill and Melinda Gates Foundation. I would appreciate if we could give them a round of applause. Secondly, I would like to thank the organizing team for the outstanding work. Please give them a hand. Thirdly, we would like to thank all the experts who came to Addis to share their experience and expertise. A very big thank to our moderator. She did a really amazing job. And finally, I would like to thank you all for joining us for 2 days. And I know you will need to catch up on your emails and work, right? So the weekend looks quite nice, right? So this is the reason why we have also decided to cancel the exam scheduled for today. So please, a hand for yourselves. Just a quick reminder, the survey will be shared online together with the slides. And of course, you have the contacts of the ESX team. Feel free to reach out, feel free to engage. This is really important. Finally, we are free. Thank you for your attention and have a good weekend.